look at the time value of money. We will begin talking about the time value of money too, right? And after this topic, after the sources of finance, the rest are going to be calculations. So I expect that you have your calculators beside you. So after this topic, I'll give you like 5 minutes to get your calculators. Then we move on to the next topic. Hope you are all cool with that. Okay. So, okay. Thanks, Juliana. So, without wasting my time, let's begin today's topic. Sources of finance, right? So I'll begin with a question. If you want to start a business today, what are some of the things you would need money for, right? If you want to start a business today, what are some of the things you would need money for? Yes, you can unmute, don't raise your hand, you can unmute and talk. You want to start a business today, what are some of the things you would need money for? I'm listening. Anyone can talk.
Maybe cost of renting the venue or buying a building to operate a business.
Thank you very much. So you need money to pay for rent, right? You need money to pay for rent. Others too would need it to build the building itself. Who again? Yes. Rita, you are going to start a business. What will you need money for? Whatever form of business, what will you need that money to do?
Okay, depends on business. If I'm into manufacturing, I will need money for raw materials.
Raw materials, you need money for inventories. Frida, please, Miss Frida, what would you also need money for? Okay. Frida is not here. Okay, Frida, talk.
I'm here. I'm here.
Okay, you need money to do what?
For food items.
Food items, if you're also engaging. Okay, so you two inventories. The last verse, Juliana, let me hear your voice. You two, what would you need money for? Starting a business, what would you need money for?
The money you use for your capital. What
okay,
you use
so
to purchase your goods. Yeah.
Okay. So she too says that she would use money to finance everything, right? To purchase goods and everything, right? So as a business, we all understand that we cannot operate, we cannot expand, we cannot even begin without money, right? So as Sam said, some will use money for rent. They use it to pay rent. Some will use it to buy equipment, inventories. Some will use it to pay salaries, even in transport, in electricity. Whatever it may be, you still need money for something, right? So that's the whole idea of what we are going to be studying. That as far as your business, you need money for different purposes. You need to obtain money for different purposes, right? So that begins our lecture called Sources of Finance. Where would we get this amount of money, right? So a source of finance is where a business money comes from, right? The source of finance is basically where business money comes from, right? So if you open a printing shop, you can obtain money from maybe your personal savings. You can go in for bank loan. You go to your family members. You go to investors. You can go to credit unions, right? So each of these ones I've listed, they are all like sources of finance, and we should understand that as a business, at each stage of the business, you need money. So even when you are starting the business, you need money. When you are purchasing an asset, you need money. You are purchasing assets like land, buildings, machinery. You need money, right? Sometimes you buy goods, want to buy goods, and process it to their final product. Then you resell it for money, right? All this, when you are buying even goods, you need money. When you want to pay your workers and suppliers, you need money, right? Even if you want to expand your business, you need money, right? Now, finding the finance is the most challenging thing for most entrepreneurs, right? Finding where to get money to generate returns is what most of the times is the problem. But at this course, we are going to learn how to, we are going to learn the types and the sources of finance each and everyone can, as a business, you can partake in it, right? So the overview, we'll look at the introduction, to which I've already done. Then we look at the classification. After classification, look at short-term sources of finance and long-term sources of finance. Okay. Now, I've explained what sources of finance are, right? They are the most explored area, especially for entrepreneurs about to start business, right? As I said, the source of finance is basically like where you get your money from. The source of finance is where business money comes from. So if you want a definition, it's like a source of finance is where a business money will always come from. Now, there are various sources of finance, right? But our lecture, we've classified them into three categories, right? Now, in terms of classification, we have the classification based on the time period. So that's one. Classification based on the time period, as you can see here. I wish I could highlight. Okay. Okay, we can highlight. So we have classification based on time period. That's one. That's one. Right. Classification based on time period. The other one too has got to do with classification based on ownership and control. And the last one has got to do with the classification based on the generation of the finance, where you generate it from, right? And you go through each of them one by one. Let's see. Okay. Now, in classification according to the time period, we can classify our sources of finance according to time period. We can have the short-term finance, the medium-term finance, and long-term finance, right? All the time, a lot of books make the medium-term finance and the long-term finance, but in our study, we have, according to the time period, we have it in terms of classification in terms of the long-term, right, the medium-term, and the short-term. So when you hear of long-term, what comes into your mind? Finance. I want to hear your voice again. A lot of the things I'll be asking you, right? When you hear of long-term finance, what comes into your mind? The entirety of the slides has got to do with we classifying short-term finance and long-term finance. Right? So long-term and short-term, yes. What comes into your mind?
Please
to be like listening.
Well, there are sorts of finance which the repayment involves. The repayment takes more than 5 years to complete.
Okay. So that's for long term. And what about short term? The accounting students, so short term will be like less than a year, almost 1 year or less than a year, right? Okay. So, but we'll go deeper into these ones, right? So in terms of classification according to time, we have the short-term finance, right? So for short-term finance, is a finance that normally required for less than 1 year, right? And for short-term finance, we mostly use it to finance our daily operations. Examples of daily operations: you want to buy inventories, you want to pay suppliers, you want to pay your short-term bills, right? Like electricity, you want to pay your short-term bills. These are what short-term finance most of the times are used for. But we are saying that for short-term finance, they are normally required for less than 1 year, right? And in terms of the medium-term finance, this one is required for a period longer than the short-term finance, but it's shorter than long-term finance. And most of the times for medium-term, it's mostly lasts like up to maybe 3 years. So medium finance is finance required for a period that is longer than the short term, but it's shorter than the long term. I'm mixing the words, but so that's for medium term. Okay, so for the medium term, most of the time you use it to finance activities like maybe you are replacing an asset, you are renovating your premises, you are undertaking some moderate expansion, and these are medium term finance. But the main one, which is the long-term finance, right? This is like a form of finance that is required for several years. For long-term finance is required for several years, sometimes for 5 years, for 10 years, for 15 years, for 20 years, right? And for such finance, that one we use it to purchase assets that will remain in the business for a long time. We want to use it to most of the times finance or purchase asset that will remain in the business for a long time, right? So, example, you want to purchase a land, you can go in for long-term finance. You want to purchase a building, a heavy machinery, right? You want to do some major expansion of your projects. So the simple rule is that for short-term finance, you should normally, it's used to finance short-term needs. And long-term finance is usually used to finance a long-term need or long-term asset. So that's it about the category according to the time period. Then the classification according to, the second one is classification according to what? The ownership and control rights. So the classification according to the ownership and control, that one we have two under them, right? We have the owned capital and the borrowed capital. So sometimes you have owned capital and borrowed capital. You can start a business and you are financing it with your own capital or borrowed capital, right? So when we say owned capital is money provided by the owners of the business. So the money you use as a business owner, you use to finance your business. So own capital can be shares. It can also be your personal savings. If it's in terms of partnership, like money contributed by the partners, and for company, that's for when you issue shares. Sometimes to even retained profits too can be on your own capital, right? The business owned capital. But borrowed capital is when you obtain fund from lenders. You go and lend, go and borrow. Let me use that word. You go and borrow money, or you lend it from others. So the borrowed capital, you can go in for bank loans, you can go in for overdrafts, you can go in for bonds, debentures, and other ones, right? Now, the distinction between the owned capital and the borrowed capital is that for borrowed capital, you normally repay it back, right? And it's when you are repaying the entirety of that amount, you have to pay it with interest too, right? But for own capital, when you finance your business with your own capital, you don't need to pay yourself back the entire amount of, maybe you'll be paying yourself with maybe some dividends or some profits. But for borrowed capital, you need to pay them interest, and you also have to pay back everything you owe them. Okay. So that's the classification according to what? Ownership and control. Then the last one has got to do with the classification according to the source of generation, where we generate the money from, right? So according to the source of generation, that one we just have to internal sources and external sources. And from the word internal sources are like the internal finance, right? Internal finance, it comes from within the business. So any amount of money you can generate within the business. And how do we generate money within the business? It can be to finance projects, right? It can be retained profit. You all know retained accounting students, so you know retained profit. Profit we don't give to shareholders. We don't. The profit we retain it for the successive next year, right? So it can be retained profits. It can be even sales. You generate money through your sales of maybe or disposal of some of your assets. These are all internal sources you can generate money from. And external sources are money that comes from outside the business, right? Can be bank loans, even government grants, trade credits. All these are external sources of finance. So the classification, as I said, we have 3 classifications now. I keep on repeating it, hoping that maybe you get it down. So according to the classification, it has got to do with what? Classification according to time, classification according to ownership and control, and classification according to the source of generation. Very crucial that you know this one. Okay, so let's move on. So we'll be, for our slide, as I said, for our topic, we'll be looking at the classification according to time. We just look at short-term financing and long-term financing. And we look at a whole lot of ways we can finance. As I said, for short-term, we use it to finance most of the times our working capital. That's our current assets, right? We look at ways we will be able to finance such short-term needs, right? Okay. So short-term sources of finance, right? So as we explained, short-term finance is the money that's required for less than 1 year, right? You require that money but you require it for less than 1 year, you don't need to extend such period for like 5 years. You just require it for some short period of time. You can repay it back, right? So short-term finance is money that's required for less than 1 year, right? And it is mainly used to support the current assets and your daily operations of a business, right? Now, in the statement of financial position, is that how we say it? Statement of financial position, right? You see, you have current assets and current liabilities. Are you following? You have current assets and current liabilities, right? Most of the times we use the current liabilities to finance a lot of the current asset items, right? So most of some of the things you say, when you hear of some of the sources of short-term finance, most of them can be found in the current liabilities, right? So you'd hear of bank loans, even overdraft and the rest. But what we want to tell you is that for short-term finance, we use it to support the current assets. So you are financing with short-term, right, to do what? Support your current assets and your daily operations. So your daily operation, you would require some of the things in current asset are what? You would require inventories, right? You use it to support your daily operations. Sometimes you need to pay some expenses. You need to pay some, yes, all of these are your current assets to which you can. Some of these are the current assets and the daily operation you would need money for. So you know that current assets, we include your cash, our inventory, our raw materials, our finished goods, right? And sometimes even money owed by customers, that's our receivables, right? So the reason, as I said, we need short-term finance is to do what? Finance our current assets and daily operations. So if you let's take an example, you have a supermarket, you have shelves everywhere. You have a supermarket with shelves everywhere, right? You have equipment, you have everything. But if you don't have enough cash to restock your materials there, you don't have enough material, you don't have enough money to restock your products, right? You see that you'll be facing some continuation issues, right? So that's one importance of this short-term finance, right? When you don't have, I'm coming. Now, if you don't have a lot of short-term finance, we are not saying that your business is performing badly, right? But you need it. You need it for temporary, maybe some cash shortages. You need money inside your business, right? Now let's look at short-term finance. Now you see that short-term financing is also called working capital financing. So I know you know what working capital is. I don't need to go deep. Now let's look at some of the short-term finances we'll be talking about. So we talk about trade credits, we talk about bank credits, customers advances, fixed deposits, factoring, installment credits, and loans from credit unions. So when we are told to list and explain some of the short-term finance, by the end of the session, we should be able to list these ones and be able to explain it right. We talk about trade credits, bank credits, and the bank credits, we have about 4 of them that we need to know the extension, how different they are. Look at customers' advances, right? Sometimes the customer will give you an amount of money. You've not yet given the customer a product, but they'll give you an advance. Then the rest would follow. Okay, so let's take it one by one, and let's see within about, I'm sure within like 30 minutes we should be done. Okay. Now trade credits, right? So trade credits, it occurs when your supplier allows you as a business to receive goods now and pay later. So the caveat or the main idea is that you are buying now and you pay later, right? So it's like you are financing your business though with goods, but more or less when you are going to pay the cash, you buy the goods now, you don't pay it right now, but you pay it later, right? And trade credit is one of the most important sources of short-term financing, right? So as I said, it occurs when a supplier allows a business to receive goods now and pay later, right? So most of the times for such things, you go to the wholesale supplier. They'll supply you with a goods worth some amount of money, right? Then they'll tell you that, oh, you need to pay it within 60 days, 30 days, 90 days, right? So when the dates, they will give you like an extended period. Within 30 days, come and pay. Within 60 days, 90 days, come and pay, right? So in this form of finance, we won't provide you with physical cash, right? Instead, the business will allow you to obtain the goods without making immediate payments. That's the extension here, right? For the trade credit, we won't give you physical cash to, but I'll give you the goods, sell the goods, make some amount of money and pay me back, right? So buy it now and pay later, right? Now, an advantage of the trade credit is that most of the times it's very convenient and it supports your inventory purchase. It does not require any like form of collateral. This one, there's no form of collateral here. You understand? It's all most of the times it's based on trust and your closeness with the supplier or the creditor. But a disadvantage of the trade credit is that there are some cases where the supplier, we may charge a higher price, or sometimes although he has given you the 60 days, but he would face some liquidity issues and he would want the money now, right? And that's the problem of trade credits. Yes, that's the only like disadvantage that comes into my head, that sometimes the supplier, he would want the money right now. Like, I've given you 60 days, but impromptu, they'll just come that they need the money and maybe it will disrupt your whole operations, right? Because most of the time you plan ahead that maybe to take you 60 days to pay, so you agree with him. But when they come to rescind it and they want the money now, you can't say no, right? So that's it about trade credits. Any question for me? If not, let's move on to the next one, which is bank credit. So you see, under bank credit, as I said, we'll be talking about these four, right? Okay. Any question on trade credits? If no question, then let's move on. And am I moving fast? Am I talking fast? Are you all okay?
Yes, please. It's okay.
Okay. So let's move on to bank credit, right? All right. So here, bank credit is like, it's like a short-term finance, but here it's provided by the commercial banks to businesses, right? So here it's like commercial banks will grant short-term finance to business firm, and we call it bank credit, right? So bank credit is like a short-term finance provided by commercial banks to businesses, right? The bank will allow you as a borrower, it will allow you to receive some full amount immediately, or it will tell you to withdraw it in installments, right? So in terms of the bank credit, they can give you the entire amount you want now, or they'll tell you, oh, you can withdraw it in installments. Withdraw it small. When you say installments, you don't withdraw the entire amount. It'll be like you need 5,000. If you need 5,000, then for every month, come and take 1,000. Then for 5 months, you take the entirety of 5,000 you've gotten, right? Now, under the bank credits, we'll be looking at the loans, right? We look at short-term loans, talk about cash credit, talk about overdraft, and discounting of bills. So when you go to the bank for loan, when you go to the bank and you need money, it's not all about going for a bank loan, but we are trying to tell you that we have other means, or we have other ways you can also garner money from the bank, right? Okay, let's take with the first one, to which we all know, right? Bank loan. So this one is like a short-term loan, right? So yeah, a bank loan is like a specific amount of money that the bank will advance to a borrower, right? I'll give it to you as a borrower. And after some time, or after an agreed period, you repay back the amount of money you took, right? So that's it about a bank loan. Bank loan is a specific amount of money advanced to a borrower and repayable after an agreed or specified period. Now, the major feature of the bank loan is that interest is charged on the full amount of loan, right? So you come for the loan, you come for it on January. How much did you come for? I came in for 1,000 Ghana cedis. When we are charging you interest, we charge the interest on the full principal amount, right? So when you go to time value of money, you'd see a lot of calculation around these ones. So you do simple interest and compound interest. We learn how to compute the interest. But what we should know is that for bank loan, the entire amount you came in for, you pay interest or you charge interest on the full amount of loan, right? Even if you are not using the amount right now, that one we don't care. All we know is that you came for the amount of money at this time and you have to repay it to us at this point in time, right? We know the day you came for it, we know the amount you came for it, and we know when you would pay for it, right? We don't care whether you use it or not. All we know is that you pay us interest on the full amount of money, right? So when you come in for bank loan, you pay interest. Then at the end of the period, you also pay what? That whole amount of money you borrowed, right? Okay. Now for bank loans, to when you are going for these loans, you need to provide us with some form of security that you would pay us back our money, right? So most of the time, the bank will request a collateral, like a land, a building, or any form of valuable asset you have. Just show us that you are worthy, credit worthy, that you pay us back our money, right? So in summary, for the bank, for the loan, for the short-term loan, the loan is given to the borrower at a fixed amount, right? And the borrower will pay the interest according to the loan agreement, right? And at the end of the year, you pay back the full amount of the loan. Okay. So that's it on bank loans. Now let's come to cash credits. Okay. So for cash credits, what you can say about cash credit is that it's an arrangement in which the bank allows a business to withdraw money up to an approved limit, right? So we let you withdraw money up to an approved limit, right? We are not saying you have money in the account. We are just saying that when you come to the bank, we allow you that. It's more or less like you are borrowing from MTN. Let me use that one. MTN will give you, for that one, we are not saying have cash inside your account to know. You need quick loan. Let me use MTN for it. You need quick loan, right? You need quick cash, right? So they will give you a limit that you can't withdraw above this limit, right? When you withdraw, you need to pay before you come and withdraw again, right? So that's it about cash credit. If I'm to give you an analogy, it's like quick loan. You go in for that amount of money, but I know that we would always give you a limit. The bank will give you a limit. You can't withdraw above 500 Ghana cedis. You can't withdraw about 1,000 Ghana cedis, right? So the bank would give you a limit. Now, when the bank is charging you interest, they don't charge you interest on the limit. They only charge you interest on the amount of money you came in for, right? They will only charge you. So if let's say your credit limit is 50,000, right? When you withdraw 10,000, right? When you withdraw 10,000, you would need to repay this amount of money. But when we are charging interest, we don't charge interest on the 50,000 credit limit. We just charge you interest on the 10,000 you came to borrow, right? And you cannot borrow above the credit limit. Are we good? Okay. So that's it about the cash credits. It's more flexible. It's like a flexible way of borrowing. You repay if you need. When you repay it, then you need it again. You can go in again and go and borrow. That's it about cash credits. Now, mind you, I didn't say anything about you need to have money in the account before you borrow, right? Because the next thing is called overdraft. And for overdrafts, yeah, it's overdraft. An overdraft occurs when the bank allows you as an account holder. So you have to be an account holder, one. So it allows you as an account holder to withdraw more money than the amount of available money you have in your account, right? So they make you withdraw in excess. So you come to your bank account. How many do you have? How much do you have? Oh, I have 2,000 Ghana cedis, right? Now you need about 7,000. So when you go to the bank, you withdraw 7,000. The bank allows you to withdraw in excess of the amount of money you have in your account already, right? So let's say your account balance is 2,000, right? And you made some payment for 7,000, more or less, you're able to withdraw 7,000, right? How much do you think you actually borrowed? Or how much do you think the interest will be charged on? You have 2,000 in your account, but you withdrew 7,000. How much did you overdraw? I'm listening. This is a question for you, right? Let me see if I can type it here.
5,000.
Yes, thank you very much. That's 5,000. Oh, your account balance is 2,000, but you made or you withdrew 7,000, right? So how much did you actually borrow? 5,000. Now, when the bank is charging interest, would they charge interest on the entire 7,000 or the 5,000 we talked about? Yes, I'm listening.
No, 5,000.
Yes. So that's it about. So that's it about bank overdraft. We let you withdraw more in excess of the amount of money you already have in your account, right? And when we are charging you interest, we charge you interest on the borrowed amount of money. But just like the cash credit tool, you have a limit on the amount of money you can borrow, you can overdraw, right? Here too, they give you a limit. You cannot withdraw, or you cannot, yes, you cannot withdraw in excess of your limit. They mostly give you a limit for you to, overdraw, right? Okay, now for overdraft, one key thing is that an overdraft is often granted based on your worthiness and your relationship with the bank. So if you need this amount of money, you have to build some form of, the bank must be able to trust you, prove to us that we can trust you, we can give you an amount of money, right? You have to show some form of credit worthiness. When we move on further, I'll explain what credit worthiness is, right? You need to show to us that you can pay the amount of money you are going to take, right? So the difference between a loan and an overdraft, right? For the loan will provide you with a fixed sum of money for an agreed period, right? That one will provide you with a fixed sum of money. You come in, we give you a fixed sum of money, then we give you a period of time for you to pay. But for an overdraft, here we allow the customer to just withdraw more than the account balance they have within an approved limit. So here we are letting you withdraw more than you have. So you should have money in your account. That's it about overdrafts. Okay. Let's come to the next thing called discounting of bills. Okay. Now, a lot of businesses do engage in import and export. Some also do, like, even in the country itself, they do some form of how do you call it, delivery. Let's say someone is in the northern region, they want to give something to someone in Ashanti region. Sometimes, more or less, they engage in these form of long-term trading, right? Long distance trading, right? But most of the time, for these discounting of bills, it's usually used in these import and export, right? Now, what is discounting of bills? Discounting of bills is where a business may sell goods on credit, right? I'll sell my goods on credit to, let's say, any customer, right? I'll sell my goods on credit to them, right? Then I'll receive a bill of exchange or a promissory note showing that the payment will be made on a future date. Okay, so this is it. I sell my goods to you. Then you give me a promissory note. You are promising me that, oh, I'll pay you the amount of money in the future. Sometimes they'll give you a bill of exchange. It's just like a certificate or a sheet, right? They are guaranteeing you that, oh, these goods you've given to me, this good that is in my possession, I'll pay for it on this future date, right? Now, immediately you get this this piece of paper, this bill of exchange, this promissory note. What you can do as a business is that you might need the money now. You can't wait. Maybe you planned with the importer or the exporter. You plan with them that, oh, they give you the promissory note that they will pay you maybe in the next 10 months, right? But here lies the case, you need the money now. So what can you do? What can you do? Right? They've assured you with a promissory note. They've assured you with a bill of exchange that, oh, I'll give the money to you in the next 10 months, right? And here lies the case where the business also need the money now. What can they do? The business can present this bill of exchange. They can present this promissory note to the bank, right? Then the bank will discount it and pay the amount of money right now. right? So that's it about discounting of bill of exchange. Now the word here is discounting. Any time you hear of discounting, it means that we are bringing something to the present value, right? So the amount of money they said they will pay to you in 10 months is called future value. You are going to discount it. You are going to bring it to present value right now, right? That's it. So we'll discount it, right? And when we are discounting it, we won't pay you the entire amount. So if you're expecting to receive 2,000 in, let's say, by the end of this year, and you need the money right now, you go to the bank, you present them with the bill of exchange. You present them with the promissory note that, oh, this customer says they are going to, they've assured me, they've assured, and we've signed a contract with them and their bank that they are going to provide me with this amount of money at the end of the year. You take that certificate to the bank. Then the bank, let's say the amount is 2,000, right? The bank will discount it to the present value. Then they'll give you that amount of money you are requesting for, but they won't give you the entire amount of money, right? So that's it about discounting. Let me see if I can provide an example here. Let me delete this one and see if I example here. So let's look at this example. Like, you go to a customer, you sell a goods worth 20,000 to the customer, right? Then they promise you that, oh, this 20,000 this 20,000 worth of goods you give to us, we pay it to you at the end of the year, right? So they'll give you a promissory note or a bill of exchange, right? Now the value of the bill is 20,000. That one we know. The value of the bill is 20,000, right? Now, because we need the money right now, we can't wait till the end of the year. We have we have like another 5 or 6 months to the end of the year. We can't wait. So what we do is that we go to the bank with our bill of exchange, right? We go there that we need the money right now. Then the bank, with their interest rate and whatever, they would form of discount this 20,000, and they will give you 19,000. This is the amount of money they will give you as a business. They'll give you this amount of money, right? 19,000, right? So to the bank, how much are they getting out of it? 1,000. So that's what discounting means. You are discounting something in the future to the present. Anytime you discount something to the present, right, it most of the time it reduces. Why am I saying this? When we go time value of money, you would appreciate this. Just like someone promises you that I'm giving you, let me give you an example, right? Let me give you a proper example. 100 cedis right now and 100 cedis in, let's say, in December, are they the same? This is a question. When we rate time value of money, you appreciate it better. But for now, just discounting and compounding, I want to say something small about it. 100 cedis right now, I'm giving 100 cedis right now, and I promise to give you 100 cedis in the future. Let's say at the end of the year, in December, which one would you choose?
I will choose right now.
Why?
What I can buy with the 100 cedis now, maybe I couldn't buy with the.
You wouldn't be able to buy it in the, yes. Yes. Thank you. And that's it about when we read time value of money, you'd appreciate this. But that's what she said. 100 cedis right now, the things 100 cedis can buy right now. If you wait till December, my friend, that 100 cedis won't be able to buy that same quantity of commodities you were imagining you could buy, right? So as a bank, right, if you are telling us that we should wait for 20,000, we should wait till the end of the year to collect like 20,000, then you have to compensate us some amount of money, because there are factors such as inflation, there's risk of, there's a risk that the customer even you are talking about, anything can happen to him, right? So for bearing this risk, you need to compensate us, right? That's why they are taking about 1,000 and they are giving you 19,000. So that's it about discounting of bills, right? Okay. Are we good with discounting of bills? Let's move on today. Okay. So that's it about cash. That's it about bank credits. Under bank credit, we looked at loans, cash credits, overdrafts, and discounting of bills, right? Now let's look at something around banks, right? The types of securities required for credit. Okay, come in. Okay. Now, here we are just trying to say that banks will not grant you credit only because you request it, right? We won't grant you the credit because you requested it. These three slides, they are not sources of finance, but they are trying to tell you that as a business, banks won't give you the credit just because you requested for it, right? They need to assess the likelihood that you would be able to pay it, right? So it's more like a security required for bank credit. If you need a bank credit, then provide the bank with some credit security that you pay it back, right? And the slide says that there are two ways in which, as a borrower of their finance, there are two ways to which you can prove to them that you are credit worthy. You can prove to them that you'll be able to pay back it. And in terms of securities, we credit them. We classify them into two ways. We have the personal security and security of tangible assets. Now, let's look at what personal security is. So, personal security refers to a borrower's credit worthiness. So, as I said, I'm going to explain what credit worthiness is, right? So, for personal security, it refers to a borrower's credit worthiness. How worthy are you for us to give up our money, right? So, credit worthiness is basically your financial strength. The bank will look at your financial strength, your previous borrowing history. When you borrowed in the previously, were you able to pay on time, right? They look at your past dealings with the bank. That, oh, previously he came for some amount of money, he was able to pay it. They also look at that your ability and your willingness to repay. That's it all about credit worthiness, right? So if you're able to collect money and you're able to pay it on time, you pay your loans on time, most of the time you are mostly classified as credit worthy, right? So in terms of security you provide to bank, you could provide them with your personal security, where you prove to them that you are credit worthy, or you provide them what other forms of security. More or less, you pledge your valuable assets. You are coming for the loan. When you are coming for the loan, you can pledge your valuable assets in that you can tell the bank, if I'm unable to repay this loan, I'm using this land, this piece of land, this insurance, this shares. I'm using these ones to secure or to secure the loan, right? Using to secure the loan, that if you're unable to pay, you pledge these valuable assets that they should take it, they should sell it, right? So more or less, this security is the way banks protect themselves from losing the amount of money, right? You need to prove to them that you are credit worthy, and you also provide them with some form of security, again, through your shares, fixed deposit, life insurance, precious metals like gold, right? That gold there, you show it to them that you can pay the amount of money, right? So that's it about proving to banks that you can repay your loans. Okay, let's move on to the next source of finance. So far we've talked about two sources of the short term, right? We've talked about trade credit and bank credit. And the bank credit, where we looked at 4 ways to where the bank can credit us. Let's look at the rest. Customer advances. Okay. Now, customers advance, right? So for customer advance, it occurs when the customer pays part of their price before receiving the goods, right? So it's more or less an advance payment the customer makes. I've not yet received the goods, but it's like I'm paying to, make you aware that I need the good, right? I'm paying before you give me the good for the final amount. So this also source of finance to business, especially those who are engaging in these developmental projects. Like someone would want you to build a furniture for him, want you to build something for him, right? So they'll first give you you've not built everything, you've not done everything for them, but they'll first provide you with an advance payment. And when you are done, they'll also give you the part payment they've not also done, right? So that's it about customer advances, right? The customer will finance part of the production before even receiving the product. That's customer advance. Okay, let's move on to the next one, which is installment credits, right? So anytime you hear of installment, it's like you are paying it sequentially, you are paying it small by small. Okay, so Installment credits, it allows a buyer to receive an item after paying a small initial amount and settling the remaining amount through periodic payments. So for you are paying something in installment, how does it work? Let's say you're going for, most of the time these ones are for maybe televisions, refrigerators, vehicles, right? Most individuals or persons, let's say they go in for these assets, televisions, refrigerators, right? Then they'll pay some initial small amount of money. Then they'll go into some agreement, then they'll pay the amount there, or they'll settle the remaining amount in installment. More or less, they'll pay some fixed amount small by small till they finish paying all the amount of money, right? So there's also some form of finance, right? Now here, in terms of interest is mostly like merged into that installment payment you make. So you count for the goods, right? You are using the goods, right? You've not fully paid, but you are using it. You need to pay me some installments, small amount of money, then you're able to finish paying everything, right? And as a business, you can do that with most of your suppliers, right? You need some assets, you're going for it. You need to purchase it. I don't have all the money. So you go into an installment credit with them. You pay the amount of money, small, till you're able to pay everything, right? So that's one way you can also finance your business. Now, the next time is the credit unions. I don't know where each of you work, but I believe that for most of you, you have credit unions around you, right? So credit union is like a financial organization established to support members. It's not only financial, but it's like we create that organization just for the welfare of our members, right? So we have the Teachers Association. I know we have the doctors, nurses, whatever association you might find yourself in, right? They mostly want to look at the welfare of their members, right? Okay. So most of the times for credit unions, they pay dues and the rest, right? And these dues, they can use this amount of money to, for their members. The members can come and borrow it, right? They can come and borrow this amount of money most of the times for maybe their personal purpose, for business activity, maybe an emergency expense you need to make. You can go in for the credit union loans. Are we okay? So that's it about the credit union loans, right? A financial organization established to support their members, right? Their members, if you're not a member, you cannot access this form of finance. And for some businesses, they do have unions to which you can borrow from them. Okay. So that's it about loans from credit unions, right? Now, the next thing is factoring. I think this is the last short-term finance. Okay. Now, for factoring, I'll try and explain it to the best way I can. Okay. So for factoring, here is the case as a business, right? You've offered your goods on credit to these customers, right? So you have a book to which you have your creditor's name, you have the amount of money allocated for them to pay and the number of days they should pay, right? Now with the factoring service, you need the money right now, but it's like the customers are proving hard to get, right? So all you need to do is you go you go to the factors, you go to their services, you go for their services, you go to the factoring company, right? You present your trade receivables details to them, and their job is to do what? They are going to collect it for you, right? They are going to collect it for you. Now, with the factoring service, what they are going to do is that when you provide them with the book or whatever document you have your receivables inside, their job is that either they are going to pay you, they look at the total amount of money your receivables are owing you. Then maybe they'll pay you like half of the amount of money because you need the money right now. So they'll pay you like half or a part of the money. Then they will take it upon themselves to look for the customers and go and collect the money for you. So when they collect the money, then they will pay parts of the amount that they've not also added. They will pay it plus it, right? But you should know that you are engaging them for service. So you need to also pay them some amount of money. So they won't give you the full amount of money on your receivables in your receivables account, right? They will first give you an initial payment. They'll collect all the money for you. Then they would also settle the rest for you. And they'll settle you with the amount that's left, right? Okay. Now in factoring service, it's more like they are going to manage your receivables for you. You go to a factoring company, they will manage your receivables for you. But there are two things we need to learn about, right? Let me see if I can highlight it. We have two things. Okay, let me see if I can. So factoring companies offer a range of services in the area of sales administration and the collection of amounts due from trade creditors, right? A factor can take over the administration of sales invoicing and accounting for client company and the rest, with collecting amounts due to trade receivables and chasing up slow payers. A factor can offer a cash advance against the security of trade receivables, allowing a company ready access to cash as soon as the credit sales are made for an additional fee. A factor can take on any bad debt that may arise through, this is the word I needed, non-recourse payments, right? We have the non-recourse payments or the non-recourse factoring. That's the word I needed. The non-recourse factoring. Let me see if the next slide also talks about. Okay. So we have the non-recourse factoring and the recourse factoring. Yeah, I think they didn't state it here. Okay. Those are the words I needed. Okay. Now, right now, you understand what the factoring is. Now, let's understand what recourse factoring is. We have recourse factoring and non-recourse factoring. Recourse factoring and non-recourse factoring. Okay. So as I said, for the factoring service, we'll provide you with some initial amount of money. The factoring company, they will advance you with part of the money before the customer would even pay. They will advance you with some of the money, right? So in recourse factoring, we talk about recourse, then non-recourse, right? So in recourse factoring, if the factoring company moves around, chase the customers for you, right? They will chase it for you. Now, if they do that and the customer fails to pay they fail to pay, right? They fail to pay, like we've chased the customer for you, we've done everything for you. The customer is not paying, like the customer is telling you that he's in bad debt, he has no money. More or less, the money is now bad debt, right? In recourse factoring, the business is required to compensate the factor. So the amount of money I gave you, you'd have to pay me back my money and you have to compensate me, right? That's recourse factoring. For non-recourse factoring, the factoring company will accept the risk of bad debt, right? So for non-recourse factoring, that one, if you give me the amount of money and you chase the customer and chase and the customer is not paying, there's more or less something happens to the customer is now dead, right? Right now it has become a bad debt. For non-recourse factoring, the factoring company accepts the risk of the bad debt. So it's more or less you as the original business, you won't pay any amount of money back to them, right? You won't pay any amount of money back to them. So in recourse factoring, that one, the factoring company does not take any form of risk of bad debt. But for non-recourse factoring, the factoring company accepts the risk of bad debt, the risk that the customer will fail to pay the amount of money. Okay. So basically, in factoring services, for factoring, we are converting our credit sales into a faster access to cash. That's factoring. We are trying to convert our credit sales into a faster access to cash. Any question for me? Any question for me? If not, I'll move on to the next thing. Any question? Yes, I'm listening. Any question for me? Okay. Silence means no questions. Okay. Let's move on to the next, and that's the long-term sources of finance, right? So for long-term sources of finance, we can say that for long-term source of finance is the money that's required for more than 5 years. More than 5 years, right? 5 to 10, 15, 20 years, right? So long-term finance are money required for more than 5 years, right? And depending on the nature of the business and investments, right? So depending on the amount, the form of need for which you need it, that's what classifies it as a long term, right? And most of the time, as I said, in terms of needs, it's used to finance major projects and it's also used to finance fixed assets. So when you go to your statement of financial position, right, a lot of your long-term finance, right, they use it to finance your non-current assets or your fixed assets, right? So those machinery, those computers, those land and buildings, right? Those projects we engage in, right? Most of the times, our long-term source of finance are used to finance these fixed assets and major projects, right? And when you go to the fixed asset, we can have your land, your buildings, your machinery, and sometimes we have some permanent working capital. Some working capital, you need it, right? It's like it's permanent, whatever be the case, you need it, right? So sometimes we need use it to finance some permanent working capital or current asset. We use it to finance some permanent current assets. So that's it about long-term finance. Money required for more than 5 years, right? And it's mainly used to finance fixed assets and major projects, right? Now, for long-term finance, it's key that we understand some things, right? You need to understand these ones. I wish under short term the slide talked about money market. It didn't. Okay, I'll come back to that. Now, under the short term, the long-term sources of finance, you need to understand where we can access the short-term finance. For the long-term finance, forgive me. For the short term, I didn't talk about the where, right? I didn't talk about the specific name for the rest, but that one is called a money market. And for long-term source of finance, where can we access them? We have the capital market. Okay, so stay with me as we go through the capital market. We go through the capital market. Then later, before we talk about these ones. So these ones are distinct. This is the market where we can get long-term finance. Okay. Now, what is a capital market? So a capital market is more or less like a system, right, through which companies, institutions, and the government, they can raise long-term finance. So it's more or less like as the slide says. Okay, sorry. As the slide says, capital market refers to the organization and the mechanism. That's why I call them like a system through which companies, other institutions, and governments raise long-term funds. So in the capital market, a lot of companies are there, governments are there, there are some institutions also there, right? They are also there, right? Now, what are they going to do? That's a place where you can raise long-term finance. You can raise long-term finance, right? Can raise long-term. Now, how can you raise long-term finance in the capital market? So the funds, it can be raised through shares, can be raised through bonds, debentures, long-term borrowing, foreign financial markets, and a whole lot. So in the capital market, it's like the capital market is not like your ordinary, like your fiscal market where they are selling and buying of goods there. But here we are selling and buying, we are buying financial assets such as shares, bonds, debentures, right? That's how the capital market is. But the best definition you can get a defined capital market, it mostly comes, I think, every year. Capital market, primary market, secondary market, short money market. For these definitions, they mostly always ask you. So I start again that a capital market is more or less like a system through which companies, institutions, and governments raise long-term finance, right? So in the capital market, just like in an ordinary market, we have buyers and sellers. For the capital market here, we connect organizations that need long-term money with investors that have money to invest for a long time, right? So here we are more or less, we are connecting those who need long-term money, those who need it, to those who have it, right? We are connecting both of you, right? So one side of the business is looking for money, and the other one is looking for investment opportunities, right? So you can also, if you want to invest, you can also go into the capital market and also go and invest, right? So under the capital market, there are two forms of markets there, right? Especially for, we are looking at it in terms of for companies and for big corporations, right? For the capital market, we have two forms of market that are also there, right? We have the primary market, we have the primary market and the secondary market. We have the primary market and the secondary market, right? So under the capital market, we have the primary market and secondary market. Very easy to understand. For a primary market, it's a market that deals with newly issued securities, right? So if you, let's say, I don't know if you heard of the news where Casapreco wanted to, issue their shares for the first time, right? So when they are issuing shares for the first time, they go into the primary market, right? So the primary market is where companies who want to issue their shares for the first time, right? So where a company issues shares or bonds for the first time, right? That's where they go there. That's where they go, the primary market. So when a company issues shares or bonds for the first time, the investors can purchase them directly from the issuing company, right? And the company will receive the money that's raised from that. So that's the primary market, a market that deals with newly issued securities. So as a company, I'll issue securities out. I'll issue shares that, other companies, other investors should take up my share. When I'm issuing it for the first time, I go to the primary market, right? But for the secondary market deals with security that has already been issued, right? So it's like, this is for the first time. You are entering the market for the first time. And this is for existing securities. Everybody knows about your business. Everybody knows that we've already issued shares before, right? You just come to the secondary market. If you need extra securities, if you need extra amount of money, you can come to the secondary market, right? So a secondary market deals with securities that have already been issued, right? Investors buy and sell existing shares and bonds among themselves. So in the secondary market, let's say you're a shareholder, you want to sell off your shares. You can come here and come and sell off your shares. If you're a shareholder, you want to buy shares, you can come here. If you're an investor, you want to buy shares, you can come here and come and buy shares, right? So that's it about the secondary market in a capital market. So in a capital market, a market that deals with long-term sources of finance, right? Under that place, we have the primary market and the secondary. Primary market is for securities, or it's a market that deals with newly issued securities. And secondary is for existing or securities that have already been issued, existing securities, right? So that's it about the capital market. So it's important to note the difference here, right? Okay. So that's it about capital markets. Yes, I've already explained these ones. Okay. So and add up to the short term, I didn't explain that one. So under the short term, let me add that one to it. A money market. Right. So before we talk about this one, we should have first talked about what a money market is. Right. So money market. So you see, for capital markets, you say it's a system through which companies, institutions, and government raise long-term finance. When you talk about a money market, that one too is a market, or it's a system through which companies, institutions do what? Raise short-term finance, right? So these are the short-term finances. But the market, all these are in the money market, right? A market where short-term finances are being funded, right? So here is for short-term, a market for short-term finance. So examples of short-term finance are the ones listed down there, right? So the money market is a market for short-term finance, and the capital market is a market for long-term sources of finance, right? So under the long-term sources of finance, you're going to take them one by one and look at this. Now, under the capital market, we have something called equity financing and debt financing, right? So equity financing is like raising money by giving investors an ownership interest in the business. That's why they are calling it shares. We have an example as shares. So when you are financing your business in the long term, right, you need long-term finance. You can go into the capital market for equity, or you can go in for debt. So as I said, we can issue securities. The securities can be equity. We can issue shares that investors should come and take up shares and be part owners of the business, right? And at the end of the period, for them, you give them dividend. We can give them voting rights. We give them capital gains on the value of their shares, right? So that's it. In terms of equity financing, you issue up shares and tell investors to come and take up shares and be part owners, right? Now with equity finance, as I said, since they are financing it with more like their own money, that one we don't need to pay back the full amount of money they invested into the business. You just pay them dividends. They'll be part owners forever. So they sell off their shares or the company liquidate, but they are going to be owners of the companies forever, right? So when the company is going for 10 years, they'll still be part owners, right? But with debt financing, it involves borrowing money that must be repaid, usually with interest, right? So debt finance, you issue the debentures and you issue bonds. And you tell them that they should come and take it up. Those who have money, come and take up debentures and give me the amount of money. So it's like, I'll hand over the paper to you, you give me the amount of money. Then in the paper, we have a contract that, oh, within 5 years, you have to pay back my money, right? So when I pay it back, then you are no more part of my business, right? So that's it in terms of debt financing. So in debt financing, it can be debentures and it can be bonds, right? So when you go to the capital markets, someone reads. Okay, Daniel, you can talk. Daniel.
Yeah. Please kindly explain these debentures again for me. I have heard it several bit.
Oh,
is it different from bonds, and how is it different from bonds?
Okay. Can anyone also try? I've been talking, sir. Can anyone try to help our brother here? Debentures and bonds. Yes, I'm listening. Okay. So they are quite similar. I listening. For debentures and the bonds, they are very, very quite similar. But I think the main difference between them is that one of them is for private companies and other one is for most of the time public companies, right? So for bonds, for instance, I think bonds is for public companies. More or less, I issue bonds out to the public that they should come and take it up, right? But for some private companies, they can't go into the capital market like that. So for them, they'll just issue debenture. That's what they call it. It's basically asking the public for loan, right? But it depends on what type of company you are. Are you a private company or you're a public company? But they are the same thing, right? They are the same, like the same idea, right? So as I said, for bonds, that one is like a financial instrument, a debt financial instrument. But that one is issued by like large corporations, financial institutions, government agencies, right? But for debentures, that one is for private companies. It's for private companies. And that one, most of the time, they don't even need collaterals. But for bonds, you should, when you are coming in for bonds as a company, if you are coming for bonds, you are coming to the public for money, you should provide us with some form of collateral. Tell us that, oh, when we are unable to pay, this is what you would use to, pay back the how do you call it? The bond, yes, the loan amount you've come for. Did you get it?
All right, sir. Thank you.
Okay. So debt financing is basically going to the public and asking them for money, right? Okay. So let's look at the other capital. Yes, let's look at the other long-term sources of finance, right? I'm going to take them one after the other, right? Okay. Mutual funds, right? So mutual funds, you need long-term finance. What are some of the finances you can what are some of the finances you can garner for your business, right? So the first one is mutual fund. For mutual fund, a mutual fund is like a pool of money from many investors, right? So a mutual fund is like a pool of fund from many investors, and they are going to invest that amount of money in a diversified portfolio of securities. So here is how mutual fund works. It's like for every investor, they have the amount of money, right? We have money. Each investor, we have money. I can go and invest in a particular, company. I can go and invest in a particular something, right? But for mutual fund, they are trying to tell you that, oh, why don't you bring your money to us? Let us manage it for you. It's possible that even company you are going to invest in, it will not profit you much, right? So for mutual funds, they will collect money from investors. Then they'll invest in a diversified portfolio of securities. When I say diversified, they don't invest all the amount of money in one particular business or one particular project. They'll invest it in a diversified one, so that even if one fails, if the other one makes a success, we can still get money. That's it about diversification. If it were left to you as an investor, you would have lost your money maybe focusing on maybe a particular project. But here, the mutual fund owners or the mutual fund manager, he's the one, he will collect all the money from investors, right? Like a pool, and he invests that money into a diversified portfolio. So instead of just one investor buying many different securities alone, the investor will just purchase units of mutual funds. Then the professional fund manager will invest that pooled money, right? So it's more or less as I said, the professional fund manager or the mutual fund manager, he would ensure that he invests that pooled amount of money into portfolio. And most of the times it helps to do what it minimizes the risk and ensures that you make good returns, right? It minimizes risk. So you have money. These are all sources of finance. You have money as a business. You have money. You can invest your money into mutual funds so that they generate even more money for you. So don't tune your mind on only borrowing. Sometimes you have money to which you would want to invest for a long period of time, then recoup back your amount of money, right? Now, the features of a mutual fund is that I think that it's listed here that basically the investor will contribute money by purchasing units, right? So let me use the slides to explain. So the features of a mutual fund is that it is a trust into which a number of investors invest their money in the form of units to form a large pool. So the mutual fund, although you are investing our money, but it's more or less you invest it in form of units, right? So it's like you purchase 5 units. When you purchase 5 units, how much did you invest? Well, I invested 1,000. So let's say every unit is 100 cedis. Let's take that. Every unit is 100 cedis, right? If you invest 5 units, it means if you buy 5 units, it means if you invested 500 Ghana cedis, right? So more or less, you invest our money in a form of units to form a large pool of fund, right? The amount is then invested in securities by the managers of the fund, right? So the features is that you want to invest. The security manager is the one who is going to look at prudential areas where they will invest their money. Then the amount of money is invested in different securities. That's the main point, diversification. The amount of money is invested in different securities or of reputed companies to ensure definite and regular income. Thus, it helps in minimizing the risk, right? Then the fourth point is that the mutual fund schemes often have the advantages of high return, easy liquidity, safety, and tax benefits to the investor, right? So for most investors, when you do some investment, you need to pay tax, right? But if you engage in these mutual funds, you sometimes get some tax benefits, right? Some form of safety, some form of high return, easy liquidity. You need the money now, you can get it, right? Now, the fifth feature is that the net income received on the investment of the fund is distributed over the unit held. So over the amount of money you invested, they are going to give you the amount of return we got. We are going to distribute it according to the units you hold, right? and the managers of the funds are obliged to redeem the unit on demand or on the expiry of the specified period, right? So according to the terms of fund, we agree. According to the terms, we agree. When I'm withdrawing my amount of money, the fund managers are obliged to ensure that I get my amount of money. So that's it about mutual fund. Mutual fund. Mutual fund, it pulls a fund that pulls money. It pulls money from many investors and invest the money into diversified portfolios. Now let's come to leasing company, right? Think leasing, then we talk about sales and leaseback. You've done leasing in accounting, or have you not yet? Have you yet not done it? Have you done leasing? Accounting students. I'm asking you. Have you done leasing?
No, sir.
Oh, then you do it. I'm sure you do it this, but you do it this semester or what? Level 400. Okay. So leasing is basically, it's like it allows a business to use an asset without immediately purchasing it, right? When you are saying you are leasing an asset, you are leasing an asset. Basically, you need an asset. Let's say you need an asset to, do some. You need an asset to do some building, right? Especially these mortar mixtures. I said mortar mixtures, these cement mixtures. You see that machine, you see it outside. Some people are leasing it out to other people, other companies to use this, right? Leasing is like you're renting your machine. But here in this case, when you are leasing, more or less, you go to a leasing company. The leasing company has purchased the required equipment maybe you need. They have the equipment you need. So you go to the leasing company, then you tell them that, oh, you need this, you need it for, let's say 5 years. You need the machine to run your operations for 5 years. You are not purchasing the machine. You are just using it for your operations, right? So you are not the owner of the machine. You are just a user of the assets, right? So you come and use it for, let's say you're telling you I need it for 5 years. So when you're using the asset, you have to pay me back. You have to pay me you have to make some lease payments, right? Periodically. And most of the time we call it rent. So for leasing, we have two parties. You have the lessor and the lessee, right? So the lessor is the owner of the asset or the leasing company, and the lessee is the user of the asset, right? So during the lease period, ownership normally still remains with the lessor. That's the owner of the assets, right? So as I said, leasing allows a business to use an asset without immediately purchasing it. So a leasing company will purchase the required equipment you want, and it will allow another company to use it in return for a periodic rent or periodic amount of money, right? And most of the times for these leasing companies, they do work with the manufacturing companies, right? So let's say a manufacturing company would need a machine. He cannot afford to buy it, right? So he just goes to the leasing company. Let's say the leasing company will go and purchase the machine. Then they'll lease it out to the manufacturer for a long period of time, 10 years, 5 years, right? Then the manufacturer will use the machine. I'll use the machine for whatever purpose I want, but I'll pay an annual rent. I'll pay an annual, it's like you're renting it, so you have to pay an annual rent, right? So depending on the lease agreement, the lessee may be allowed to purchase the asset at the end of the lease period. So there are some times where in the lease agreement, let's say you've used it for about 15 years, right? Maybe at the end of 15 years, you tell the company that, oh, you want to purchase it. It all depends on the lease agreement you go with. But on the normal, for leases, they are just allowing you to use our assets without purchasing it immediately. When you're using, you pay us rent. So that's it about leasing, right? Now, under leasing too, we have something called sale and leaseback. Sale and leaseback. This one. I don't know why they say. Call it sale and leaseback. You can call it sale. That's the popular word we mostly use. Sale and leaseback. So what is a sale and a leaseback, right? So for sales and lease back, this is what companies mostly do. So the sales and lease back, it occurs when the company will sell an asset it already owns to a leasing company, right? I have an asset as a business. I have an asset. I'll sell my asset to a leasing company, right? When I sell my asset to the leasing company will give me money, right? I sell the asset to the leasing company, then the leasing company will give me some amount of money. Now, when they give me the money, then I tell the leasing company that can they lease me back the assets they've already bought from me. Now, when they lease it back, you'd have to pay them their you have to pay them the periodic rent amount of money you normally have to pay, right? But you should know that you are not the owner of the asset anymore. You are not the owner of the asset anymore. The leasing company is. So for sales and lease back, here the company does what? He receives cash from the sales of the asset, but he will continue to use the asset, but he will not be the owner of the assets, right? So it occurs when the company sells an asset it already owns to a leasing company and then leases it back. So I'll sell it, then I'll lease it back. I'll sell it to a leasing company, then I'll go to the leasing company, then come and lease it back, right? So that's the main thing. So the main idea about sales and lease back is that the business will convert their own issued assets into cash without immediately losing the use of the assets. I'll still use the assets, but I need to convert the asset into cash. Then later I come and lease it back, right? So that's it about leasing and sales and lease back. We are almost done. We are left with about 3 more. Any questions under leasing? Any question for me? Okay, no question. Let's continue. Let's continue with the next source of long-term finance. Now with this one, we call it special. We have special financial institutions, right? So for special financial institution, for these ones, I've not seen some in real life before, but the slides list YEF and Maslock, to which I do have no idea about them. But for special financial institutions, they are established by the central government, sorry, or they are established institutions that provide not only financial services, but they also provide non-financial support to businesses, right? So they are set up by the central government to provide long-term finance to organizations. They also offer support services, so not just financial. They also provide support services. So they may assist you with maybe starting your new business, expanding your existing business, maybe modernizing your equipment, training your entrepreneurs, providing long-term finance. So these are special financial institutions. And I don't know if any of you have heard of YEF and Maslock before, or any institution that also not only provide long-term finance, but also some source of support to businesses, right? Have any of you heard of YEF and Maslock? I'd have loved if I could search for it. Let me see YEF and Maslock. Maslock. YEF and event designed to harness Maslock. Maslock is a microfinance and small loans center met with the National Youth Authority. Yes, so as I said, they are set up by the government, right? It's close partnership with National Youth Authority on apprenticeship. Yes, okay. Yes, Maslock and YEF, they are institutions set up by the government. They don't only provide you with long-term sources of finance as a business startup or anything. They also provide you with support like training of your entrepreneur, your workers, even training entrepreneurs and those who are starting new business. They help with that, right? Okay, so these are special finance institutions. Let's look at venture capital, and the last one will be, angel investors. Okay, so venture capital. So from the word venture capital, here is like a form of equity finance, right? So for venture capital, it's finance provided to young, privately owned businesses with strong growth potential. So if you're young, privately owned, these things can come in OBG, right? So for venture capital, we are using to finance young, privately owned businesses with strong growth potential, right? So here we are providing you with money in exchange for ownership share, right? We are providing you with money in exchange for a share, right? So we are saying that the venture capital is normally in a form of equity finance rather than loan, right? But we are providing it to just young, privately owned businesses with strong growth potential, right? With strong growth potential. So most of the time for the venture capital, when they come, they mostly examine the quality of your firm, the quality of your management, the growth potential of your business. They look at your business model, your market opportunity. How marketable are you? Are you taking advantage of opportunity in the market? You look at even the amount of amount invested by your founders, right? And possibly they look at your profits, right? So that's the venture capital. A capital that's used to support young, privately owned businesses with strong growth potential, right? If you have strong growth potential, that's where these venture capital, these capitalists, yes, these venture capitalists, they come inside and they provide you money. But they are not just providing you with the money. They also want a form of ownership or a share of your company, right? Then the last one has got to do with angel investors. Angel investors, right? So angel investors, they are individuals or they are investors who invest their own money in small and young businesses. Yeah, they are interested in helping small businesses survive and grow. So their objective may be more than just focusing on the economic returns, right? Angel investor, they are individuals who invest their own money in small and young businesses. So they may provide you with capital, business advice, mentorship, and management experience, right? So angel investors may invest at the earlier stage and provide you with smaller amounts than venture capital. That's the difference. Angel investors, for them, they invest at an earlier stage and they provide you with smaller amounts than venture capital. So for them, they are not just looking at they are not looking at how they're not looking at how profitable or how what's the word? Word is not coming. They are not looking at your growth potential, but they are concentrating on an early stage, smaller business or young business, and they provide you with the capital, the business advice, the mentorship, right? They still expect profitability and protection for their investment though, but it's more or less they invest at the early stage of the business and they will provide you with a smaller amount than the venture capitalist. For venture capital, they'll provide you with a large amount of money, right? So for angel investor, if you want to look at the difference between angel investor and venture capitalist, for angel investor, they are usually an individual, right? They are investing their personal fund, right? But for venture capitalists, they normally invest money managed by professional investment firms. So that's why for them, they don't pay. They always look at, it's like you scouting a player. Those who watch football, it's like you scouting a player. You go and buy a young player and you develop it. That's how angel investor is. For venture capital, they look at like your potential. They look at a lot of things before they invest because they are not using their own funds. They are using people's contributed amount of money to invest, right? So these are the sources of finance, right? These are the sources of finance, right? So I'll conclude by saying that for all the sources of finance we've looked at, every source of finance, it has a cost, it has a benefit, and it has a risk, right? So as a business, if you are entering into any form of these finance we talk, you must always consider the amount of money you need, how long you need the money for, the purpose of the finance, the costs of interest you'd have to pay, your ability to even repay the amount of money and others, right? So always consider these things before you engage in any form of finance. Okay. Any question for me? Any question for me? Yes. Any questions? We are done with the first topic. We have about like another 2 hours more to which we can start the second topic. Are we good? Are we all good?
Yes, please.
Okay. So can we go for like some 15 minutes break, then we come back? I hope you're okay. I want to go and get something and get something to drink. Are you okay? So let's say it's one 12. So it's 1:12. Let's be here at 1:30. I'm not saying leave the call. Let's be here at 1:30. The next topic will be financial statement analysis. Right. Let me see if I can project that one first. So it's one. So let's be here at 15 minutes. So let's be here at 1:30. Then we do 2 hours. Then we end. Okay, so it's 1:31. I hope you're all here. Hope you're all here. Hello.
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 Okay. 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 Yeah, present.
Yeah.
Okay. Okay. So let's see within the next 2 hours. Let's see if we can finish financial statement analysis. If you're able to finish early, then you will end here. And the next time we do time value of money, then how to value financial instruments. Financial statement analysis. You're all accounting students, so I hope that you would help me very much here. Because for you guys, you know where each what's happening? You know where each line item is. When we talk about where revenue is, where current assets, you know what's inside current assets, you know what's inside a lot of the statements. So it's not going to be something very, very difficult for you. I hope so. Right. That's what I'm hoping. Okay. Now we are going to talk about financial statement analysis. Financial statement analysis. Basically, we are going to learn how to analyze financial statements. I'm sure you've already done this one thing, some before in accounting. Okay. Okay. So for every business, right? Let's look at these board of directors here. One person is saying that they looked at, I think they sat down, they looked at their financial statement. Then the first person was like, our company is doing very, very well. Looking at our profits, our company is doing very well. And another person supported, the second person supported him by saying that, can't you see our new structures? Can't you see our buildings? Can't you see what we are doing? Right? So these two are saying that, oh, the company is doing well. Another one is verifying that, can't you see our new structures? Then the third person is saying that, nah, this company is financially vulnerable. Shiara is telling you that it's just paper. You've just presented something, but if you come to the company, we are financially vulnerable. Shiara. Then after he said that, the fourth person was like, Master, what is your basis of saying this? What is your basis of saying that, oh, the company is vulnerable? Those who are saying the company is doing well too, what is your basis of saying that the company is doing well, right? So basically, the third person was like, please don't behave as if we are in Makolo. We are in a schedule. We have to schedule a meeting for our financial statement analysis that will provide us with a good indicators for judging this company. But this person's question is what we are going to do. What is your basis for saying that our company is doing well? What is your basis for saying that our company is vulnerable? That's what basically we are going to be looking at. The basis is obtained by analyzing the company's financial statement. So if you look at any company you want to make a particular form of decision, you just look at, you have to understand what basis are you basing on, what are you using, what did you see for you to make that decision, right? And that's what we are going to do. Okay. Now, the introduction, financial statements, right? See, the financial statements are used to make decisions by various users, right? Various users like shareholders and investors. The large number of figures in the financial statement do not have meaning to all users of financial statements, right? We are trying to tell you that the figures in the financial statement, not all of them make meaning to the users. You know, we have a lot of users. We will list them very soon, but we have a lot of users of financial statement, right? But not all of them will really need all the figures. Some even see, they don't even understand it. You present it to them, they see it as raw numbers and they have no idea, right? So it is our job as financial analysts to be able to do what? Interpret it. You have to be able to interpret the financial statement, right? You need to analyze it and interpret it, because the figures themselves line idle don't make any meaning. So our job is to do what? Interpret it, analyze it, right? So that we can, provide them with what useful information for their decision making, right? So all these theories are just talking about how essential it is for us to interpret, be able to interpret and present the financial statement, right? But let's discuss this. Let's recap on these ones, right? What are the users of financial statement, and what do you think their financial information is? So how many are we? We are about, you have to say yours first before someone sees it, right? You tell us, yeah, 1, 2, 3, 4, 5, 6, 7. Yes. 7 people. You mentioned a user. You tell me, what do you think their information needed? Why are they even interested in the financial statement? What do they look out for? Something simple, right? So let's start. Who will start? If you don't start, me, I'll mention him. Yes. What are the user financial statements? You mentioned their information need. This one's a recap, so I'm not going to talk crap.
Close up.
Daniel,
Shareholders.
yes, you are listening. Shareholders. Yes.
Well, they are interested in the profitability of the business so that at least they will expect higher dividend payout.
Thank you very much. Right. So they are interested in the profitability of the business so that they can, vie for more dividends, right? Or dividend payout ratio, right? So thank you. So shareholders or potential investors, right? Potential investors, so they are interested in your profits to know whether your business is more profitable enough for us to invest or not. Okay. Thank you very much, Mr. Daniel. Shareholders is out. What again?
Creditors.
Rita is saying creditors. Okay, creditors or suppliers. Okay, let's start.
They are also interested in the company's ability to pay debt on time. So they use the information to decide whether to provide goods or services on credit.
Okay, thank you very much. So they also look at your credit worthiness. Would you be able to provide the amount of money we gave to you on time? Right. Okay. Thank you very much, Rita. Zenyo.
Employees.
Okay, employees. Okay, sure.
They are also interested in job security, wages negotiation, and company stability.
Thank you very much. Yes. So they are very much about the continuation, the survival of the firm to continue in the foreseeable future, right? So that you can assure them of their job security in terms of wages and negotiation. So they look at your profit to check whether you have enough to negotiate for better wages and better working condition. Yes, we have 4 more people. Yes.
Okay, so we have board of
Yeah,
directors.
Juliana. Sure.
So
But Daniel, I'll wait for him. Continue, Juliana.
We have
Board
the
of directors.
directors. So
Okay.
they need information to see the progress of the how the business is going, so that they'll be able to make their
Better
decisions.
decisions. Yes. Yes. So we know that for board of directors, they make strategic decisions for the business. They make long term. So they need to know whether the business is doing well or not. Right. Okay.
Hello.
Danny, I thought you had run away.
No. Government.
Government. Thank you. Yes.
Yes. The government will be looking at compliance with policies and regulations, and also for taxation purposes.
Yes, please. So they are very much interested in your compliance with every form of regulation and taxes, right? Taxes. If you don't follow regulations, you'll be penalized, you pay penalty. In terms of taxes too, you can't, skip them, right? Then the last person, Danny. Hey, 3 Daniels. How?
Okay, so I will talk about creditors and suppliers.
Someone said creditors, so say customers. I said, yeah, customers and receivables. Someone said creditors.
Oh, okay, and suppliers. Okay.
Okay, so you can talk about customers. About customers.
Yes, customers, yeah. And yes, they are also looking at how the company will produce quality goods or services to them, and also at an affordable price.
Thank you.
That it will not affect their pockets.
Yes. Yeah. A lot of customers, for instance, they rely on their company's survival for their production, right? So they're also interested in your survival, as Abad also said. They're interested in you providing them with better prices for their commodities. They're interested in the decisions the company even taking, or as to the line of product they'll be going into and the rest, right? So thank you very much. looks like this topic is done and dusted, right? So you've been able to list some of the users of financial information, right? Okay. Now, in terms of the approach to which we are going to analyze, we are going to do the vertical and horizontal analysis, right? And we'll do the ratio analysis. And I asked if you have your calculators, to bring your calculators, because there are questions inside to which I would need you to verify the figures for me. Okay, so we have the common size analysis, then the ratio analysis, right? We first talk about the vertical analysis, talk about the horizontal. I think these are the main two ones. Then the trend is, most of the time you want to know the trend for a whole year, but we will talk about that one too. But we'll solve questions on the vertical and horizontal, right? Okay. So vertical analysis. How is a vertical line drawn? Let me see if I can. Oh. How do we draw vertical lines?
From top to down.
Thank you very much. Good. Okay. So this is how vertical lines look like, right? And horizontal is like what? This, right? Okay. So for the vertical analysis, you see vertical, we are moving from top to down, right? Vertical analysis is more or less, you are going to take every line item and we divide it by a base figure, then we multiply by 100. Now, you see, in our analysis, we'll be analyzing two major statements. We analyze the income statement and we analyze the statement of financial position, right? With the income statement, we take every line item. I said for income statement, in vertical analysis, for income statement, we take every line item and we'll divide by sales or revenue. Another name for sales is revenue, right? We'll divide by your total revenue. So every item, you're going to find a percentage of it in terms of revenue. So if we take revenue, cost of sales, divided by revenue, we want to see the percentage of revenue that has gone into this, right? So that's it about the vertical analysis in the income statement. For vertical analysis in the statement of financial position, you take each item and you divide it by total assets. How do you find total assets? Yes, how do you find total assets? Accounting students. How do you find total assets? It's your what? What plus what?
Fixed asset plus current assets.
Thank you. So that will give you total asset, right? So in the statement of financial position, you take every line item and you divide it by total asset, to which we said total asset is your current asset plus your current non-current liability. Current asset plus fixed asset. Current asset plus non-current assets. That's what I was trying to say. Okay. So that's vertical analysis. We take it again, right? Horizontal analysis is called year-on-year analysis. Year-on-year, right? So you have 2012, 2013, 2014, 2015. If you want to do horizontal analysis, you just take the revenue of the current year you want. Let's say 2025, 2026. Let's use that one. You have 2026. You just compare it with 2025. So if you pick revenue, pick current. You can do current minus previous all over previous, or you can do just current over previous times 100. Whatever way, you get the answer. Are with me? We'll try both of them and you'd appreciate it. So horizontal is like year on year. Compare this year to the previous year. Compare this year to the previous year, right? For trend analysis, it's also a form of horizontal analysis, but that one, most of the time, you pick a base year. So let's say 2010 is our base year. You compare each and every year to the base year and look at the trend over time. So it's a horizontal analysis, but you want to, compare 2020, 2011, 2012 to 2026. You're comparing each item to the base year. So it will always be current over base, current over base, current over base. So if you're in 2011, it will be 2011 over 2010. If you're in 2012, it will be 2012 over 2010. If you're in 2026 over 2010. That's trend analysis. You want to know the trend over time. We should know that for horizontal analysis, is your current year over previous, current over previous. You are just comparing the current previous year, right? Just the year that passed by. You want to compare that one, right? And for ratio analysis, we'll talk about the ratios, the profitability ratios. That one too, you delve deeper there, right? Okay. So let's start with the vertical analysis, right? Then let's do an example. Are you with me? So what did I say about the vertical analysis? For vertical analysis, you are doing what? You are comparing, we are analyzing the financial statement though. We are trying to find the percentage change though, but what are you trying to do? We are going to look at, we are going to set each and every item as a percentage of a particular item. We are going to more or less compare every item to a particular base figure. And here the base figure here is revenue and total assets. It depends on where you are standing. For the statement of profit and loss, the base figure is revenue. For the statement of financial position, the base figure or the benchmark is what? The total asset. So here the formula would always be the item or the line item you are talking about divided by revenue. And here we'll be looking at it in terms of each year's own, right? Looking at it in terms of each year's own, then multiply it by 100, right? So if I could, I can't paste anything here. This is a PDF. We can't, okay, we can. No, I can't. Okay. So if you want the income statement percentages, every item in the income statement divided by its revenue, its year's revenue times 100. I'm sure you've done this. You've done this one before, right? So you look at every item in the income statement, you divide every item by what? Revenue. So cost of sales over revenue, gross profit over revenue, right? Times 100. Then you come to 2017 to everything. But you should know that these things you are doing, you need to interpret it to us. You understand? As I said, these figures don't lie in idle. You need to interpret it to us. Okay. Let's first do the calculation, then maybe the interpretation will come later. And for the statement of financial position, I said every item, you are dividing it by what? Total assets. So if your non-current asset is this one, you have to add it and make sure you know your what? Total assets. Some questions will be silent. Don't write total asset here. You will even leave this figure there. You would need to add it and find your total assets. Are we cool? Okay, let's start with it. Let's start with 2016, right? Let's start. We are going to find the percentage. Let's take it as if you are finding the percentage, right? You are finding the percentage like these ones. This is how I want it. Something like this. Okay. Yeah, but we are going to do it. We're going to do it here. I can't fill the table, but when you tell me the figure, then I write it down, right? So in terms of revenue, if you want to find, we are doing 2016. You're just doing 2016. That's vertical, straight like this. Every item divided by revenue. So let's start with revenue. What will be the percentage? You tell me the answer. You tell me how you did it. To be what?
100%.
And how did you get 100? It's what?
10,000
divided by 10,000. So every item we are dividing by 10,000. Now let's come to the cost of sales.
70%.
70%. So 7,000 divided by 10,000 times 100, right? So you can say that for every 100% sales you make, you were ABC company, more or less, they spent like 70% of their revenue on goods sold, cost of goods, right? Cost of goods, right? Okay, let's continue. What about gross profit? That one to be what? 3,000 over 10,000 times 100. You are getting
30%.
30%. So this is the amount of money. About 30% of the revenue was gotten after we paid off our cost of sales, right? Let's come to expenses. What percentage of revenue was spent on expenses? 800 over 10,000. Yes, I'm listening. 800 over 10,000. Every item divided by 10,000.
8%.
8% of our revenue, out of our revenue for the year, about 8% was used to do what? Finance our general and administrative expenses. What about then selling and distribution will be what? 1%.
1%.
Yes. So about 1% was used to finance our selling and distribution. Then finance cost in terms of maybe any form of interest we paid, it would be what? 15 over. So out of the revenue, you see how I'm always saying out of the revenue figure, how much was used to pay for finance costs?
0.15.
0.15, right? So when you less all these expenses from your gross profit, how much are you getting? You are getting 2085, right? So let's find the percentage after paying off all our expenses. What percentage of the revenue was left? It used to be 100, then went to 30%. Right now, what's left? About what? 20 point something, right? 20.85. Am I right?
Yes.
Yes. So out. Yes, after paying off, our profit used to now be 30%, but after paying off all the expenses out of the revenue, about 20% of the revenue, 20.21% of the revenue is less, right? Now we pay our tax. How much of the revenue are we paying as tax? What percentage are we paying as tax? 521 all over 10,000. What percentage?
$5.21.
5.21 of our revenue is being used as to pay for our taxes, right? And what's after paying all taxes and paying all expenses and everything, what is our profit out of our revenue? How much profit do we make? What's the margin? Most of the time we call this one net profit margin, right? The margin on sales we make.
15.64%.
Is that 15.647? Okay, thank you very much. So that's how we do the vertical. Now this, you see, we did it for 1 year. So if you want to do it for 2017 to the same method, just know that this time you won't be divided by 10,000, dividing every figure by what? 12,000. And as you can see here, right? What we got 15.64. Look at the percentage. The same thing if you do for 2017 too. As a percentage of revenue, you are going to get 100%, 79.17. That's 9,500 divided by this. Everything divided by 12,000. These are the percentages we got. So this is the income statement, right? What are the statement of financial position? How much would we be dividing each figure by? Someone should tell me. How much would we be dividing each figure by for 2016?
16,600.
16,600. That's the total asset. Thank you very much. So we are dividing each asset, each item here by what? The total assets. Are you hearing me? Every item by total assets. So let's do for like let's do for these ones, right? So out of the assets, how much are we using to? How much of them contributed to non-current assets? What percentage is non-current asset contributing to? Yes.
90 points.
50, forget. You said you got
90.36%.
okay. So about 90% of the assets we see, right? A lot of them, about 90 of them is being financed by the non-current assets, right? Non-current assets is taking about 90% of that, right? Then the inventory would be what? 750 over 16,600 times 100. Okay, I think
4.5.
I have the film 4.5. Okay. You take every item, divide by this, right? Let me see if I have the answers here. Okay, this is okay. You see, so 15,000 divided by 16,600, 750 over this, 600 over 250 over 16,000. You see the percentage we are getting here, right? At the end of the day, when you add all of them, you should even be able to get 100, just like the other one. Right? You should be able to, just like this one too, you should be able to get 100. The same thing, because stated capital 10,000 divided by 16,000, 20,000 divided by 16,000. Just know that you don't rush when you are doing these things. Know what you are dividing by, right? And you do for each year's own. Are we okay? Okay. Then now let's move on to that was vertical analysis. Oh, didn't we talk about horizontal analysis here? Okay. Okay, let me just read it here. Horizontal. We are moving on to the next one, which is horizontal analysis, right? Now, for horizontal analysis, what did I say it is? It's another name is what? Year on year. That's why I drew the line for you to see. Horizontal, year on year. Current over what? Previous. Current over previous times 100. Some also can do it current minus previous, all over previous, right? But a lot of us want to do it current over previous times 100. Current over previous times 100. Whatever way you do it, you get your marks, right? So for horizontal analysis, it's also known as a year-on-year analysis, and it involves comparing a particular year's result with that of previous year. So yeah, that's why we provide you with 2 years. I can't give you 1 year and say do horizontal analysis. I can give you 1 year, just 1 year, 2017, and tell you to do vertical analysis, right? For horizontal year-on-year analysis, compared to the previous year. Okay. So can we do an example of that, of the horizontal analysis here? This one, it doesn't matter. You take one line item, you compare the previous year to the current year and know the percentage change. That's what we are trying to do. Percentage change, by how much did it change, right? You take cost of sales, current over previous. You can do current minus previous, all over previous. I said any of them, you are good to go, right? Let me see how the, let me see if percentage change. Yeah. Okay, let's do this. Let's do this one first. Where is it? Revenue. Do 12,000 divided by 10,000, and let me see. Then let's all stick with one of them. Although we have 2 ways. I feel like let's stick with the current minus previous over previous. I think that's what, if we stick with one and everybody is doing that one, then we are good to go. Are you okay? Let's do current. So current, that's 2017. Current minus previous all over previous. Let's stick with that. Current minus previous all over previous. So let's start times 100. Times 100. So let's start with this one. Let's do about 3 of them and move on to the ratio analysis. Yes. So for the revenue figure, I'm listening. I'm looking at the percentage change. What is the percentage change? By how much did the revenue change? Are we doing well in terms of revenue or not? You people don't get me. Hello?
Yes.
Apart from Rita.
I don't get you.
We can hear you.
You don't get me. But do you get
Yes.
me? Rita says she doesn't.
Maybe the network. I can hear you clearly.
No, not here. Do you get me? Like, do you understand what I said?
Yes, please.
Rita, you understand?
I don't.
Okay.
You said
So for
take the
for horizontal analysis, I'm saying it's going to be the current year's figure. We're doing line item. When I say line item, take a line item one after the other, right? We take revenue. We look at the line item, right? Cost of sales, gross profit. We are going to take the current. So 2016 and 2017, which one is current? Rita, which one is current?
2017.
So it's going to be current minus the previous, all over the previous, times 100. That's the formula we are going to stick with. Current 2017 figures, all these 2017 figures, I'm going to pick them one by one. So revenue is going to be 12,000 minus 10,000, all over 10,000 times 100. Current minus previous, all over previous. So that's the formula. Because I can't write, that's why I'm not writing. Current minus previous, all over previous. So let's do this one. 12,000 minus 10,000 over 10,000 times 100.
I had 20.
Had 20%, right? So in terms of percentage change, are we doing well or not? We got a positive figure, right? We got a positive figure.
Yes.
Yes. If it's positive, that means we are doing well, right? So 12,000 minus 10,000 over 10,000. It's more or less revenue increased by what percentage?
20%.
Revenue increased by what percentage? 20%. So let's do for the cost of sales too. Of course, I will be going. But shouldn't matter the mentioned. Me, I have some top and down below. With down the mom chatting. Okay, sorry. What did you get?
35.7%.
35.7%, right? So revenue we did well. Cost of sales to have increased, right? Our cost of sales has increased to what? By what percentage? 35.71. So we are spending more in terms of the cost of sales, right? Let's look at our gross profits.
Please, Doc.
The percentage change.
Please, Doc.
Yeah, I'm listening.
Hello. Please,
I'm
so,
listening.
but by incurring more cost of sales, doesn't mean we are doing well and we are not doing well in terms of cost.
No, in terms of cost, it means that we are incurring more cost. First, because we are incurring more cost, it should alarm us that what's going on. Why are we even incurring more cost? At first, it used to be this percent. It used to be, let's say 100. Right now, it has increased by 35%. Right, everything used to be like 0. Right now, it has increased by 35, and it's alarming. Right, so we need to go there and go and look at. So it's not something good when your cost is going high. It's not something good. When your revenue is going high, it's something good, right? So it's alarming. We need to know what are the things that are causing us. But this time we are just doing the analysis. We are speaking to them, telling them your cost of sales have increased. It's possible that the things that go into cost of sales, right? What are some of the things? Your purchases. It's possible here you did a lot of purchases. And what again? Here when you add purchases, closing inventory. You less closing inventory, add closing. Yeah, you did a lot of purchases. Maybe, let's stick with that one for now. All right. If some of the things come to my mind, I'll say it. Maybe you have a lot of unsold inventories too or something. So there are a lot of costs. You can just speculate what are some of the causes. For revenue, when your revenue went high, we can also say that it's possible that you started engaging in a lot of advertisement. It's possible you did what you did. You made a lot of production, or the demand for your product went very high, so you made a lot of sales, right? So here you just speculate and tell us what are some of the things you think that increased your cost of sale. But it should always go in conjunction with what is in the financial statement, right? So if you are saying the inventories went, maybe we bought a lot of inventories. When we go to our current assets, we should be able to see that percentage change, right? Look at the inventory. In 2016, it used to be 750. Right now, look at what the inventory is, 1,105. So, do you see why the cost of sales is becoming very big? Hello? Or you still don't understand what I said?
Yes.
You understand?
Yes, please.
So that's why the cost of sales is increasing at an alarming rate. Now let's go our gross profit. So our gross profit, in terms of gross profit, did it increase or decrease? So it's even going to be it decreased by what percentage?
Negative 16.7%.
Because it's negative, you use the word decreased. So when you use decrease, don't also use negative. You understand? It's like you put in a negative, you put in a bracket here and also coming to write less cost of sales. It's like you're repeating the same thing. So it decreased by what percentage? Don't add negative to it. It decreased by it decreased by what percentage?
16.7%.
16.7%, right? So our gross profit has fallen by 16.7%, right? Then other ones you can also, go through and do it. Let me see if I have it here. Okay. So our revenue increased by 20%. Our cost of sales did what? Our cost of sales also increased by 35.71%. Our gross profit, because of the brackets, I can say it decreased. Gross profit for the current year decreased by 16.61. Our general administrative expenses increased by 12.5. Our selling and distribution increased by a 50% rate, right? Finance costs didn't increase or decrease. It was the same. Our profit before tax decreased by a 31.18%. Because our profit has decreased, so as our tax we would pay would also decrease, right? Then our profit after tax also decreased by this percentage, right? So that's for the profit and loss. For the income statement, to the same thing. Our non-current assets, you compare 16,500 minus 15,000, all of 15,000. We just do the comparison and we'll be able to, we talk about it here. Oh, where is it? Okay, I think it's here. Okay. I'm coming. So there's, I think the headings, they didn't write it. They're supposed to be horizontal, but wrote vertical. Okay. So non-current asset, we can say that, oh, our non-current asset, we invested in non-current asset because there is a 10% increase in the non-current asset. More or less, we bought a new vehicle or we bought a new asset, right? Our inventories increased by 34%, right? Inventories, it increased by 34%, right? So we bought a lot of inventories during the current year. Our accounts receivable, we made a lot of sales to which we didn't receive money, and that's increased, meaning that the sales figure we see in our revenue figure, we see about 16.7 of them, about about this percentage change, right? That's increased. Maybe it used to be something, right? It has increased by 16.71%. And in terms of cash, that's in the business, that's reduced by what, 20%, and the rest follows, right? So are we good with the common size analysis? Are you good with them?
Yes, please.
Okay. Okay, thank you very much. Now we are going to move on to the ratio analysis, right? For ratios, it says that it shows mostly used is going to, you are going to use it to check the performance. It's more or less a performance analysis. That's what most businesses use. Apart from doing the common size analysis, they also do the performance analysis. And here, basically, it depends on the user of the financial statement. A lot of users would want to know the profitability. One would want to know your working capital in terms of your working capital. Others would also want to know a lot of aspects, right? Different aspects, right? So as financial analysts, you should be able to group them so that each of our everybody would be able to know like what's happening at each point in time in terms of profitability. Are we doing well? In terms of investment, in terms of liquidity, do we have enough cash in the business? Another person would want to evaluate your capital structure, that's your debt or leverage. You would also want to know your debt structure. Are we having too much debt in the business? Are we doing well or not, right? Now, the ratios, basically, they summarize large amounts of financial information to simple ones. They're going to summarize them. They're going to identify important relationship. They make comparison even very, very easier. They identify areas that are your strong point and not like, they identify your strengths and weaknesses, and they help in making financial decision making, right? And as I said, in terms of the analysis we are going to do, we look at two statements, the statement of financial position and the income statement, right? So the ratios we'll be looking at is the profitability ratios. Under each ratio, that's the heading, but we have like, some of them, we have like 5 ratios, some 6, some 3 ratios under them, right? And it's your job that you get to know, you should know all of them, but yes, at least know them. Know them for yourself. Know them for yourself at least. Okay. So we'll talk about the profitability, the working capital, your liquidity, your debt, investment ratios, right? If I'll open another slide and I'll add some things to it. Most of the time, these ratios are for manufacturing companies. You see, for manufacturing, they are the ones who they have revenue, they have cost of sales, they have inventories. But what about banks, right? So that one we later open another slide and we look at how to, evaluate the performances of banks too. Okay. But banks also, we can also compute all these things for them, right? But sometimes we can't compute something like working capital. They don't have some items like inventories and the rest. So let's go through them one by one. Okay. So profitability ratio. So profitability, basically, you are just measuring your company's ability to generate profit from sales, right? When you make sales, you're going to look at, are you able to generate profit from your sales, from your assets, from your capital? Your ability to generate profit from your sales. your assets, your capital, your shareholders' funds, right? This is what the profitability ratio is going to help us know. Are we able to generate enough profits from our sales, from our assets, from our capital, from our shareholders' funds, right? Now, these are the ratios to which we'll be looking at, right? Now, we write it in the acronym here, but the full name is here. We have the return on capital employed, which is the rules. Return on equity, ROE. Return on equity, we'll come back to this one again. Return on assets, gross profit margin, net profit margin. Then we have the assets turnover ratio, right? The easier ones are the margin ones, right? Anytime you hear of margin, it's like divide whatever thing they've said by sales. So when I tell you gross profit margin divided by sales, net profit margin, divide the net profit by sales. We have operating profit margin. That one is where you do the profit before interest and tax over sales, right? Okay, let's take them one by one. You have the return on capital employed. Return on capital employed. Now the formula for return on capital employed is your net profit before interest and tax. Basically, it's your profit before interest and tax. Let me see if I can. Let me see. Okay, this one, they didn't bring this one. Profit before interest and tax. This one is profit before taxes. Means that when you say profit before interest and tax, the profit before interest and tax will come before the finance cost, because that one is the interest. Okay. When we get a better question, or when we are doing about writing out, we'll solve some questions, then we'll go through them, right? Or when we have time. I think, okay, let's go through the formulas. When we are done, we'll solve some questions, right? So return on capital employed is your net profit before interest and tax. So this is not your actual net profit, it's just your profit before interest and tax, all over capital employed times 100, right? What is capital employed? Capital employed, to find capital employed, is your total assets minus current liability. So write it somewhere. Your capital employed is your total assets minus current liabilities. That's one way we can find it. Or another way is to add all your equity plus non-current liabilities, right? Add all equity plus non-current liabilities. But the most preferred one is the total assets minus current liability. That's how we find capital employed. So return on capital employed is your return all over capital employed. Return on capital employed. Return on capital employed is like I'm saying that something on something. Divide the returns all over capital employed. But the return is profit before interest and tax all over capital employed. Okay. Capital employed is total asset minus current liability. Now, what does the return on capital employed tell us? Right. So return on capital employed measures the profits generated from long-term funds invested in a business, right? So the yellow line is assess the return an entity makes on the capital invested. So what is the return we made on the capital invested? If I look at the amount of money we invested into the business, right? What's the return we made out of it? That's return on capital employed. Thank you. I won't talk again. I'm getting tired, but let's continue. Return on equity. So write it somewhere. After that, I'll share this one with you. Hey, I forgot the person I took the number.
So the previous one, you didn't share it to us.
You know what's funny? I read the number down here. I took my phone. Then someone called. After that, I forgot. Came back. I couldn't find the number. So when we are done, this one, when we are done, I'll try and send it. I'll be intentional about it. Bye. But this one, I'll send it before even we start doing any calculation so that we just look at it then. Okay. So the next one is return on equity, right? How do you do return on equity? Return on equity is basically your net profits. That one is your actual net profit. Profit after tax and preference dividend, to which return on equity is like your actual profit after tax, your net profits all over total equity, right? Your net profit all over total equity. That's return on equity, return on equity, return on equity. This one, it measures the return and on ordinary shareholders, and for ordinary shareholders, sorry. Return and for ordinary shareholders, right? We said profit after tax and preference dividend. So if there is any form of preference dividend, just subtract it from your net profits, right? But if the question is silent, just use net profit after tax, right? So profit after tax minus preference dividend, right? Then you just divide by equity shareholders fund. That's total equity. Then return on assets, right? Return on assets, just like the rules, we use profit before interest and tax. This one use profit before interest and tax. Return on assets is also using profit before interest and tax. It's only return on equity that uses profit after tax and preference dividend. So after you pay off your dividend, we want to know the amount of money that's left for shareholders. A return on assets is telling you that out of the assets you have, how much profit did you generate? Did you effectively use your asset to generate enough profit, right? So there's profit before interest and tax, right? Then the next ones are gross profit margin, net profit margin. To which I said, anytime you hear margin, it means divide whatever thing you've heard by sales. Net profit margin, divide net profit by sales. Gross profit margin, divide gross profit by sales. Operating profit margin, divide operating profit by sales, right? Whatever be the case, you just divide it by sales. Then we have the asset turnover ratio. Asset turnover ratio, right? This one mostly is not asked, but asset turnover ratio is just your sales over your capital employed. Sales over capital employed. Sales over your capital employed. So these are your profitability ratio. But the easy ones are the gross profit margin, net profit margin, return on capital employed, return on assets, and return on equity. Right. Okay. We are good. Let's move on to the working capital efficiency ratios. Working capital efficiency ratios. Now, you said that working capital efficiency ratios, it measures how efficiently your company manages its working capital. That's your receivables, your inventory, your payables, these three, right? It measures how efficiently we're able to, manage our receivables. When we talk about receivables, you know them, our inventory, our trade payables, right? So this is the working capital efficiency ratios, right? Here we have three ratios, but when we reverse them, it becomes 6, right? We are going to do these three ratios. The later we will reverse them and call them the turnover ratios, right? But let's first look at this ones. So we said working capital efficiency ratios, they are ratio that assess how efficiently a company manages its receivables, its inventory, its trade payables, right? Now they are saying that the ratios are normally measured in terms of average number of days, right? The average number of days it takes for you to collect your debts, the average number of days it takes for you to pay your suppliers, average number of days it takes for you to hold inventory, right? Now, these are the ratios. As I said, we are going to talk about the debtors collection period. How many days on the average does it take for you to collect your debts? You are going to find that number of days, the number of days it takes for you to collect your debts. Creditors, you are going to look at the average time it takes for you to pay your suppliers. Then the inventory turnover period, you are going to look at the average time it takes for you to hold your inventory, right? I'm going to look at the average time it takes for you. It makes you aware that, the inventory turnover days are these days, so that you'll be able to know whether you fulfilled it or not as a business, right? So let's start with the debtors collection period. So with the debtors collection period, the formula is what? Your trade receivables all over credit sales. If the question is silent about credit sales, you can use the total sales, right? So trade receivables all over credit sales times 365 days, right? So this one will give you an estimate of the average number of days it takes your customer to pay, right? The debtors collection period, trade receivables all over credit sales. If credit sales is not given, use total sales. Another name for sales is your revenue. Use your total revenue, right? Okay. CPP, that's your creditors payment period. The number of days it takes for you to pay your creditors, right? It's going to be your trade payables all over purchases times 365. But as I said, a lot of the financial statement, the purchases is embedded in the cost of sales. So this one too, if you don't see the purchases figure directly, you can use cost of sales. So it's going to be trade payables all over cost of sales times 365. Are you good? So this one is trade receivables all over sales. I've even written it here. So when you're reading it, you can see, right? CPP is trade payables all over purchases. The formula is trade payables all over purchases, but when purchases is not given, use cost of sales times 365 days. Then the inventory, for the inventory, it will be inventory all over cost of sales times 365. So inventory and creditors, both of them divided by cost of sales. Debtors collection period, that one too is total revenue. Okay, so that's it about the working capital efficiency ratio. But let's know what a working capital cycle is. That's the fourth thing, or the cash operating cycle. Now, the working capital cycle is basically we are going to add the debtors collection period plus the inventory collection period, then we subtract the creditors payment period. It's like debtors collection period, the answer you got, the days you got, the number of days you got, plus your inventory turnover period, the number of days it takes for you to hold your inventory, right? Then you subtract your creditors payment period. I don't know if it's supposed to be down here. It's here. So your cash operating cycle is your inventory turnover, inventory holding period, plus your what? Debtors collection period minus your creditors, the time it took for you to pay your creditors. That's your cash operating cycle. Are we okay? Okay. Now, so these are the number of these, the number of these, the number of these, right? Look at the formula, trade receivables over credit sales. Now, if you want to do the turnover ratios, right? Turnover ratios of these ones, it's still under working capital. If I want to do debtors turnover, creditors turnover, right? This one, we are not looking at the period, right? Let's look at what turnover ratios are. It says that these can be used as an alternative way of telling the same story as the efficiency ratio. They show the number of times a balance in the statement of financial position is turned over in the period, right? So instead of just looking at the number of days, the same information can be expressed as the number of times a balance turns over during the year, the number of times it turns over, right? The number of times, like, it occurs, something like that. The number of times it occurs, right? So instead of doing credit sales all over trade receivables, this time you're going to, instead of doing trade receivables over credit sales, you'll be taking the reciprocal of this, right? And that one will be your debtors turnover. That's all. The debtors turnover is credit sales over trade receivables. Payables turnover will be purchases all over trade payables, right? It's like we've reversed these ones. We have reversed these ones. The cost of sales, the inventory over cost of sales, it will be cost of sales over inventory, right? As you can see here, cost of sales over inventory. These are the receivables turnover. So master just this one. When you go and they ask you about, they don't ask you about the period. They ask you about debtors turnover. You just reciprocate the formula for them, right? So the cash operating cycle, as I said, if I'm to explain it, it says that it refers to the time of one cycle of business operations from the time that suppliers are paid for the resources they supply to the time that cash is received from customers for the goods that the entity makes with the resources and then sells it, right? So the cash operating cycle basically is telling you the number of, it's telling you the number of times it takes for a business, in coagulation. You are looking at the number of times it takes for you to, get money from your suppliers to go and buy inventory. Then the time it takes for you to convert those inventory into finished goods, and the time it takes for you to sell it to your customers and receive back the amount of money and pay your suppliers, right? So that's what it incorporates here. The cash operating cycle, it takes the number of, you're looking at the number of these it took for you to collect money from your creditors to come and finance your business, more or less buy inventory and sell it, right? And collect money from your receivables. You're looking at all the number of these together, right? In total. Okay. So that's it about the cash operating cycle. Very simple. Okay. The next thing to talk about is the liquidity ratio. right? So we are done with the working capital. We are done with profitability. We've already talked about profitability. You are assessing how you're assessing your firm in terms of how much profit they made, in terms of your assets, your liabilities, in terms of your assets, your revenue, right? In terms of your profit you made, you're assessing all of them. Then working capital is looking at how efficiently you manage your receivables, your inventory, your trade payables, right? The third thing to talk about is your liquidity ratio, to which a lot of finance students, you must be concerned about liquidity, the ability as a firm to obtain cash very quickly enough to meet your short-term obligation, right? So some firms, as I said, we do face short-term obligation, to which we have to have cash there, cash available to pay all these short-term cash very quickly, right? So here we are going to, just talk about two ratios. That's the current ratio and the quick asset test ratio. And let's read the assumption. Assumption says only sources of cash available are cash in hand or cash in bank, and current asset that will soon be converted into cash during the normal cycle of trade. So under the liquidity ratio, we'll be mostly looking at our current assets. We look at our current asset and the current liabilities. And then under our current assets, you consider the cash in hand or cash at bank, right? Because cash in hand and cash at bank, they are the most liquid assets. If you need money right now, you go into the business, you go and look at our drawers. If we have cash or that we have cash in bank, that one we can easily get this cash. If we can't get this cash, if you have receivables there, if we have debtors there, we just ask them to pay back the amount of money they owe us, right? So that's an easy way to get cash, right? So under liquidity, the two ratios are the current ratio, quick asset ratio, right? Now under the current ratio, the formula is what? Current assets all over current liability. Basically, we are comparing our current assets to our current liabilities, right? Now the ideal state is what? The ideal ratio is supposed to be 2:1, more or less. You should always have more current assets than your current liabilities, right? So in this scope, they are saying that your current, if it's good, you're not saying it should always be that, but we are saying it's good that as a firm you have enough current assets so that in terms of the current liabilities you need to pay, the obligations you need to pay, your current asset can be used to quickly pay off your current liabilities, right? So ideally, they are saying it's supposed to be 2:1, right? Your current assets should be more than your current liabilities. That's what they are saying, right? Now, another school of thought said that no, inventories are not current assets. So why don't we exclude them from it? Because for inventory, if I need cash right now and you tell me to go and sell my goods, it's possible I'll go to the market and no one will buy it, right? So they are saying that, oh, for the current assets, subtract your inventory from it, right? So that one is just current assets excluding inventory. And that one, the ideal state is 1:1, right? So note the name well. Current ratio is current asset over current liability. The quick asset test ratio is your current assets minus your inventory all over your current liabilities. Okay. So that's it about liquidity ratio. So liquidity ratios is only 2. Okay. Now let's move on to your debt or leverage ratio. Your debt or leverage ratio, that one we have 3 ratios under them, right? So your debt or leverage ratio is basically looking at your capital structure as a firm. Are you financing your business with more debt or you are financing it with more equity? That's basically what the debt or leverage ratio is looking at. You are looking at a company's reliance on borrowed finance or its ability to meet interest obligation, right? So we look at the size of your firm and look at it and ask, are you focusing a lot of your money? Are you financing a lot of your business operation with debt or you are using equity, right? That's what capital structure refers to. You're looking at your debt and your equity. Debt and equity. As you see in your financial statement, finance by section, equity and debt. That's where the debt ratios look at. Looking at, are you financing it with a lot of debt or equity, right? Now, if So under the ratios, we'll be looking at the debt to equity ratios, the gearing ratio, and the interest cover ratio, right? Now, the debt to equity ratio is what's the formula? Remember, we are not looking at total debt, but the debt to equity ratio is long-term debt all over shareholders' equity. So don't come and use total debt here. In finance, we use long-term debt, right? Long-term debt. Don't use total debt. Don't say debt over equity, so total debt over equity. No. The long-term debt divided by the shareholders' equity, the total shareholders' equity. That's your debt to equity ratio, right? And it shows how the level of debt you have in your business. Are you financing it with a lot of debt or small debt as compared to your equity you have, right? Then gearing ratio is like the same as the debt to equity, but here it's going to be your long-term debt divided by your shareholders' equity plus your long-term debt, right? Gearing ratio will let us know whether you are a debt dependent, significant debt dependence firm, or like it's basically an indication of risk, as it states here, an indication of a risk that a firm will be unable to meet its obligation to lenders when due for payment, right? That's what the gearing ratio lets us know, right? That if I take a percentage of my long-term debt divided by my total capital structure, right, will I be able to pay off my long-term debt, right? It's just basically, I'm looking at how risky your firm is, right? You're just looking at how risky your firm is. That's what the gearing ratio help us know, how risky your firm is. That if we take your total capital structure, the way you finance your business, are you concentrating a lot of them? Are you getting a lot of the money from like your long-term debt, right? So it's like, look at the combination of your shareholders' equity and long-term debt, more or less your capital structure. Look at your capital structure and ask ourselves, how much is our long-term debt contributing to it? So if your long-term debt is very, very huge, then we tell you that, oh, the way you are financing your business is very, very risky. You are using a lot of debt, so it's making your firm a lot riskier. You understand? So that's gearing ratio, right? Then the last thing to talk about under the debt, the debt or leverage ratio is the interest cover, right? So the interest cover is basically looking at, do you have enough money to pay off interest, right? Do you have enough money to pay off your interest charges, right? You have the capacity to pay off your interest, right? This one, the answer, we leave it in times, right? So profit before interest and tax, all about interest charges, right? This answer, you leave it in percentage, you leave it in times. How many times it takes you can use your profit to pay off your interest, right? That's the interest cover ratio. And the last one, this is the investment ratio. And you appreciate this one very much when we start doing the valuation of securities, right? When we want to value securities, right? Now, let's look at them. We have the earning per share, dividend per share, dividend yield, dividend cover, the P ratio, that's the price, P ratio, price or earnings ratio, price to earnings ratio, right? Okay. Earning per share. So the earnings per share is basically your earnings all over the total number of shares issued, right? And how do we find your earnings? The earnings should be one that which is attributable to your shareholders, because you are going to pay the dividend out of this one, right? So your earnings per share is your earnings attributable to your ordinary shareholders. A lot of the time they don't bring preference dividends, so you just pay your net profits, then divide it by the total number of shares issued, right? So if they are silent on preference dividend, a lot of the financial statement, they don't show the dividend paid, right? So you just pick your net profits, divide by the total number of ordinary shares. But if they show the preference dividend, subtract it from your net profits. So your earnings per share is your net profit after tax minus preference dividend over the total number of issued shares, right? So that's your earnings per share. Like for every share, what's the earnings that's accruing to it. Now the dividend per share is what? The total dividend payable to ordinary shareholders divided by the total number of ordinary shares issued, right? So the total number of dividend, we announce you are going to pay this amount of dividend. So you divide it by the number of ordinary shares issued so that you know your what dividend per share. So for every share, how much am I going to get? Right. So for every share, I'm going to get this amount of money. Right. Then the third one is the dividend yield. Right. Now you see that the dividend yield is the return a shareholder is currently expecting on the share of a company. The return a shareholder is currently expecting on the shares of a company. Now the dividend per share is the dividend yield is their dividend per share all over the current market price per share. So in some questions, we give you, oh, the current market price is this is 5 Ghana cedis, right? The nominal amount is 4 Ghana cedis, but the current market price is 5 Ghana cedis, right? So the dividend yield is basically telling you that when you sell off your shares, that dividend amount in the market, how much is it really, right? So dividend per share is equal to dividend yield is the dividend per share all over your current market price per share times 100, right? Then the last one is your dividend. What is it? What's the name? Dividend cover. Last but one. Your dividend cover, right? Anytime you hear of cover, the answer is in times. The dividend cover is your earnings per share. The earnings per share you got in over dividend per share, right? And they're saying that dividend cover measures the number of times that an entity dividends are covered by profit. How many times an entity could pay the current level of dividend from its available profit, right? So that's it about dividend cover. Dividend cover. It measures the number of times that an entity's dividend are covered by profits, right? That's dividend cover. The last one to talk about is the PE ratio, price earnings ratio. The PE ratio is the opposite of, okay, I thought it's the opposite of dividend yield. Because the PE ratio is the market value of shares all over earnings per share. Now the PE ratio shows how much investors are willing to pay for every 1 Ghana cedis of your annual earnings, right? How much the real market, when you go to the market, how much investors are willing to pay for every 1 Ghana cedis of your annual earnings, right? So for your earnings you are making, how much are those on the outside they are willing to pay for every amount of earnings you are making, right? In terms of shares, how much shares will I buy for every earnings you are making, right? So a high PE ratio would indicate that the investors expect a future growth, that your firm is doing well. But if you have a low PE ratio, it gives them some this perceived risk that you're not doing well. So how do you do the PE ratio? So market value of your shares. The question will always give you the market value of your shares, right? Then you divide it by the earnings per share that you configure, right? Okay. So these are the ratios to which we need to consider, right? Now, the limitation of the ratios is that because we are not the one preparing the financial statement. You see, most of the time accountants are the ones who prepare the financial statement. We just analyze, right? They are saying that it has some limitations in terms of the ratios, right? Because one, we are going to use historical information for a lot of the statements we produce. The accountants media basically reporting on past transactions. So it's more like we are looking on past transactions to make decisions for future performance, right? We are using past performance to do what? Make suggesting for something that's going to happen or take decisions for the future, right? So one limitation of the financial statement analysis is that it uses historical information, it uses historical cost. A lot of the costs or the accounting transactions that have taken place, they are historical costs. So the figures we sometimes see, it's happened in, you see, a lot of your items that are recorded in your statement of financial position, you record them at cost. the cost you bought it. So if you bought an asset at 5,000, it's still there as 5,000. Even if you've come to the current year, it's still 5,000, right? Records historical cost. And it excludes non-financial information. A lot of things can be talked about in the non-financial information, right? So the morale of the worker, the team spirit, all of them affects the performance of the firm. But because we cannot quantify them into figures, right? That's one limitation of the financial statement analysis. It excludes non-financial statement, like non-financial information, like employee of workers, competence of workers, the product quality, the team spirits, right? Then the other one, sometimes the financial statement can be window dressed and a whole lot, right? When you get it, you can read it, right? And get them, you can read it. Okay. I'm going to see if do I have a question? Okay. But let me try and send it to you right now. So that's it. Any questions for me? Any questions for me? I have to send it. Where's my phone? Okay. Yes. Any questions for me? Yes. Any questions for me?
So I think maybe when we start with the calculation.
Question. Yeah, for now I'm just giving the formula. So yes, that's how it is. When you give the formulas, it becomes plenty. But I want to share the particular slide we used so that when we are solving a question, it's like just verify it, then we solve, right? So one of you should, let me see if I can display my number so that one of you you can just text me. The person I took the number, I've lost it. 805988640. So one of you should text me right now and text me hi, then let me forward it to you right now. As I texted, then I search for a question. Let me see if I have last look. Financial statement analysis. Who is texting me? Has anyone texted me? Okay, Rita. Okay. Let me see the financial statement analysis. It's not introduction. Trying to get I'm trying to do create a question, then we solve. Use that one to solve. Okay. Okay. Let me see if I can save this one to and send it. I'm sharing another one. Oh, sorry. Really nice. Yes, so please share it to your colleagues. Right. Share the tutorials I just sent one to two. We'll be doing that one too. going to be device. A minute, my machine is, I don't know why it's, I think it's not opening. Okay. Do you all have it? Do you all have it? Hello?
Yes, please.
Yes,
Everything.
please.
You
We
have
have it.
everything.
Yeah.
Even
Yes.
including this one and the ratio slides. Okay.
Yes.
Okay. So you can also use this one to do the vertical and horizontal analysis, but for now today we are just doing the ratio analysis, right? They say that the following financial statement released to Adon Manufacturing Limited for the years ended 31st December 2025 to 2026, right? And we're giving you the items, revenue, cost of sales, gross profits. See, it's not every book that will bold in everything for you, right? You have the administrating expenses, selling and distribution, finance cost. You have the profit before tax. This small. Okay, profit before tax. Maybe when I do like this, profit before tax. Then the income tax expense. Then the last one is profit after tax, right? Then the next things are the non-current assets, current assets. We have your total assets here. I'm just bolding them so that you see it well. You have your total equity figure here. You have your, what is it? Total. Okay, we don't have nothing. They didn't do total liabilities. They didn't do total liabilities, but we have total equity and liabilities. But they made you aware that, and that we have, these are your long-term loan, and these are your current liabilities, right? These ones. I should be bolding them in. You people mostly underline it when you are doing your this is the non-current assets. That one they give you a figure for non-current assets and give you total current assets to be these ones. Okay. Now they are telling you additional information. All sales were on credit, right? All sales were on credit. Credit, they are telling that all sales were on credit. So these sales figures you see here, this revenue figure, they are telling us what's all on credit. Okay. Sometimes the question will be silent on that one. You see that credit purchases were 340,000 in 2025 and 485,000 in 2026. Use closing balances for receivables, inventories, and payables. They are telling that anytime for receivables, inventories, and payables, use their closing balances, right? So receivables, trade receivables, trade payables, their closing balances are the ones we used. Right? They are telling that profit before interest and tax should be calculated. Yeah, they are telling you that anytime you need profit and tax, calculate it yourself. Right? Profit before interest and tax, calculate it yourself. Okay. Now he's saying that using the results, write a clear assessment of the company's financial position from 2025 to 2026 under the following heading: profitability, working capital, liquidity, and the gearing one. The fifth one, which is the investment ratio. Most of the times, you can't do it with just these financial statements. They have to provide you with more information like your dividends, your number of shares. There are a lot of questions we normally don't provide it, right? So this is just the easy ones, right? Now let's do this one at least. Okay. So which one are we going to start with from our slides? I think we're going to start with our profitability. We do working capital, liquidity, and did I close the financial statement? Analysis. Okay, see. Let me see if I can. I just copy it, then we look at what we'll be doing. Let me copy it. Okay. So under each of them, we just do like 4 of them, then we continue. Okay. We are going to start with the profitability, right? We're going to start with the profitability ratios. Are you okay?
Yes.
Okay. Now, under profitability, we are going to calculate everything 2025, 2026, 2025, 2026, right? You do for 2025, you do for 2026. So when we pick one item, we're going to do for 2025, 2026. Are you okay? Okay. So let's start with the first thing. Now, the question said something here. It says that profit before interest and tax should be calculated, right? Because a lot of the things we'll be doing, we needing profit before interest and tax, right? Something like return on capital employed, gross profit margin, net profit margin. Not all of them, but a lot of them you'll be needing profit before interest and tax, right? So let's first find profit before interest and tax. Oh, where's my okay? Oh, come on. What's happening? Okay. Let's do profit before interest and tax for both of the years. Profit before interest and tax, right? Let's calculate it. How do you find profit before interest and tax? Profit before interest and tax. Any idea? We have profit before tax. This is interest. They want us to find profit before interest and tax. Right? How do you find profit before interest and tax? We have 2 ways of doing it. So the profit before interest and tax was supposed to be here. Profit before interest and tax. Basically, when you say profit before interest and tax, you should find the profit before subtracting this interest, the finance cost, this interest and tax. So we have 2 ways. You can add the profit before tax to the finance cost, or you can do what I've done here. With this 180, you subtract 55 and 25. Are you following? So your profit before interest and tax, you're going to find profit before tax. If you want to find profit before, just add back the finance cost you deducted, right? So if you add back this one to be what? It's going to be 100, right? Profit before tax is 90,000, right? We want to do profit before interest and tax. Another name for profit before interest and tax is your operating profits. Operating profits. How do you find operating profits from this one? To find operating profits is basically subtracting your operating expenses from your gross profits, right? So this 180 minus 55,000 minus 25,000, you're going to get this 100. This 100 you see here, you're going to get it. Another way you can also get profit before interest and tax is that do what? The profit before tax, which was 90,000, you're going to subtract 10,000 from it. Add it back, just add it back. Add it back to the 9,000, you get 100. Instead of subtracting to get 90,000, add it back to get 100. Yeah, okay. What about this one? What will be the figure here? 79 plus 15 would give you what? 79 plus 15 will give me, calculator is not here.
94,000.
94,000. Thank you. 94,000. So that's how most questions we will give you the profit before interest and tax. But for this question there, the book wanted you to calculate your operating profit yourself. Okay. We have our operating profit figure, right? Okay. So let's start with everything. Okay. We are going to follow return on capital employed, return on equity, return on assets, gross profit margin, then we just do net profit margin, just these 2, right? Okay. So for 2025, you have the question with you. So when I ask for the figure, you just give it to me, right? Okay. Return on capital. I have to type. Let me just paste. Saldo. Return on capital. Now we know return on capital to be what? Our profit before interest and tax, all over capital employed, right? Right. So what's capital employed? We know capital employed formula. What do I say about capital employed? is your
So
total assets
current liability
minus your what? Current liability. Now let's go to the question. What is our total assets? But we are doing 2025. What's our total assets? What's our total asset for 2025? Talk to me.
520,000.
520,000. So let's come back. 520,000, right? Minus what? What's our current liability? Our total current liability. A total current liability. This one you have to add it yourself. You need to find total current liability. The question they didn't give us total current liability, so let's find it ourselves. Total current liability. Total current liability here will give me what? 55 plus 45 will give you
100,000.
And for this year too is going to be what? 13,750, right? What is it going to be? 13,500.
750.
750, right? So at least we have our total current liabilities figures here, right? So it's 100,000, 100. So we are doing for 2025, it's 100, right? So what is the final answer? Answer is going to be 420,000. We've done capital employed. Remember, we are doing return on capital employed. Return on capital employed is profit before interest and tax all over capital employed, right? Let's see if I can insert equation. Okay. Let me copy this. Okay. So we know what return on capital is. Return on capital formula is what? Profit before interest and tax all over capital employed, right? Am I right?
Yes, you are.
Yes.
So what's the profit before interest and tax in 2025? Profit before interest and tax in 2025. It's all about going back to see your figures. Profit before interest and tax is what?
100,000.
100,000. I want you to confirm it. 100,000. 100,000 all over. Return on capital employed is what? 420. We just calculated it. The capital employed. This one times 100, right? You're multiplying this by 100.
Yeah.
What are we getting? We're going to get 23.81.
Confirmed.
Okay. So that's for 2025, right? We are going to do the same thing for 2026. Right. We're going to 2026. We are going to just change the figures. Now let's find capital employed for 2026. That one too is total asset minus current liabilities, right? So what's our total asset in 2026? 620. Our total current liabilities is 135,750. So 620 minus 135,750. Right is somewhere 620 minus 135,750. 620, 135,750. 620, 135,750. 620 minus 135,750. That'll give me the answer. So it's going to be 484 something.
484,250.
484,250. 484,250. Right. This figure. Okay. Now let's find the return on capital employed. The formula is profit before interest all over capital employed. So let's find profit before interest in 2026. Profit before interest is what? 2026 is what? 94,000, right? This figure. 94,000. So let's just change the figures here. So it's going to be 94,000 divided by 484,250. 484,250. Right. This one, what will be the percentage? Get 19.
I have
19.41.
19.41.
Good. So there's capital employed. There's capital employed, right? Why did you say capital employed? It assesses the return and entity makes on the capital invested. So out of the capital investors invested in 2025, we were able to generate about 23.81% out of the capital we invested. In 2026, we generated 19.41, right? So there has been like a fall in the capital. Our ability to generate capital, our ability to generate profits out of our capital, right? There has been a fall, right? Okay. So that's it about capital employed. I didn't write it down. So this one was return on capital employed. Under profitability, return on capital employed. Profitability issues. One is return on capital employed, right? So the next one is what? The next one we'll be doing is return on what? Return on equity, right? Okay. Sorry, the writing sometimes is plenty. Let me just do this one. So the next one is return on equity, right? So return on equity, that one we are going to use the net profit itself. Return on equity is ROE. I'm doing 2025 and 2026. Return on equity, the formula is what? Profit after tax and net profit and preference dividend. And as I said, a lot of times we don't give you anything related to preference dividend. So you just use your net profit, the total net profit, right? Divided by total equity shareholders fund, right? Total shareholders fund. So here is going to be profit after tax all over equity, total equity, right? Profit after tax or net profit. Somehow call it net profits. Whatever way you call it, net profits or profit after tax. So we are just going to take net profit, then we divide it by what? We are going to do for 2025 and 26, right? Net profits. Okay, so let's go and look at the figures. We need net profit and total equity, right? Okay, so let's first find net profit. Profit after tax, that's your net profit. Profit after tax is 6,750, right? So that's net profit, 6,750. We're going to take 6,750. We are going to divide it by total equity. You get me? So go through your document. We have profit after tax 6,750, and this one to be total equity to be 340. If you're not seeing it, total equity is this 340. Why I say, what do I say the return on equity is? Net profit 67 what? 67, what's it 6,750? Oh, short term. 6,750. $6,750 and total equity was Total equity is 340, right? I'm not the one who be doing AO. So if you're not paying attention, times 100, and you give me the figure. The same thing for the 2026. You would have to do something similar for 2026. 2026. I have to change the figures. 2026, the total equity was 364,250. 364,250. Let me copy it. Profit after tax. Total equity is here. Total equity. Okay, so I pasted total equity first. So total equity is then okay. So there's return on capital employed. Return on capital employed. Right. I do return on capital. This is return on equity, sorry. I almost said return on capital. Return on equity. Okay. I'm not giving me the answer still. Oh. Hi people here.
The first one, I had 19.85%.
19.85%. The last one, the second one you had
16.27%.
16.27%. We really don't have time, eh? So when we do it, then you'll be fast, right?
Confirm.
So I'm sure you can do return on assets, profit before interest. We've already done the profit before interest. So you're just going to put the profit before interest, then you divide it by total assets. You can do it. Abi, I just need confirmation that you can do it.
Try our hands.
Don't tell me to do it. Good. Then gross profit margin. Gross profit margin is gross profit all over sales. You know what? They give you the sales figure, right? So you just take your gross profit margin. Pass your gross profit, 180,000 divided by sales. That's your revenue. Net profit margin. Take this one. This one, they can say operating profit margin. And they can say net profit margin. This one is your net profit margin. Right? And this one there. This is your operating profit margin. And this one is gross profit margin. Just take all of them divided by sales revenue. So 180 divided by 500 is gross profit margin. Operating profit margin 100 over. Yes. So let's move on to the next thing. Right? At least the profitability, I'm sure you can do it. These ones you can do it now. Are we good? Can we move on to another form of ratio?
Yes.
Okay, confirmation. Okay, let's move on to another because of time, we can't do all of them. Okay, let's move on to the working capital. Let me copy it. We're looking at the number of days it takes for you to, hold inventory one. That one, let me paste it here. These are the ones we are now going to do, right? Okay. We are going to do the working capital efficiency ratio, right? So under the working capital efficiency ratios, I'll be repeating the formula again because the formula is already there. Oh, I'm directing. So let's start with the DCP. That's the debtors collection period, right? And the debtors collection period, the formula is what? Oh, to copy fraction. The debtors collection period formula is what? It's right here. DCP is what? The trade receivables, right? Trade receivables. All over what? Credit sales. And I say if the question don't give you credit sales, what can you use?
Revenue.
Yes, the total revenue, right? A lot of the times. But fortunately for us, in our notes, what did they say here? He's saying that all sales were on credit, and they even give you credit purchases for each year, right? Okay, so all sales were on credit. That's why it's needed. Okay, so we'll do for 20. Right now, when I write the formula, I just do 2025 and 2026 concurrently. Do 2025, 2026. Come on. Just do 2025 and 2026 together. Okay. So give me the figures for trade receivables 2025.
It's 60,000.
60,000. Okay, good. At least 60,000. Trade receivables is 60,000. Later we're going to confirm when we are done. 60,000. And what was our credit sales? Our total revenue figure. Our credit sales figure. What is it?
500,000.
In 2025.
500,000.
500,000. 500,000. 500, sorry. Because we are doing credit, because we are doing debtors receivables, I forgot we have to multiply by what?
300.
365 days.
Thank you. So we are looking at the number of days, so times what? 365. What are we getting? The number of days. So this for 2025. Let them punch it. The person who is looking at it, let's do 2026. Yes. 2026 to us, what are the figures? What is the trade receivable figure and what is the credit sales?
85,000.
So we have 85,000.
Out of 650,000.
650. So that's debtors collection period, right? I'm just looking at the number of days it takes for you to collect your money from your creditors, your debtors, right? So what's the answer? The debtors collection period.
For 2025, I had 44 days.
44 days. It takes you 44 days. And for so 2025, you got like, yes, 44 days, 43.80, so 44 days. And the other one is, I'm sure this one will be 48.
48 days.
But you know something, when you get an answer, first write the answer, then later tell us what, like, approximately this. You understand? Because a lot of examiners has, maybe you got 43 point something. You stay that one down there, then later come and add like approximately 44 days. You get me? Because some people, I don't know how they mark. You just see, they see the figure and it's not the same as what is in their book, then they just give you wrong. Sometimes. Right. Okay, so that's debtors collection period. Can we do the same thing for creditors, CPP, creditors payment period, right? Creditors payment period. The number of days it takes for us to pay our creditors and paste everything again. This time is going to be CCP, creditors payment period. This one is trade creditors. This one is trade creditors all over what? Credit purchases, right?
Over purchases, credit purchases.
So if the question is, if the question is silent as to whether total purchase, total, if the question gives you total purchases, you can use that one. If the question does not give you credit purchases or total credit purchases, what can we also use? I said we can use our cost of sales. Thank you. Okay. This one is trade payables. So the person looking at the figures for us, 2025 was trade payables. They gave it to us.
55,000.
55,000. And our credit purchases, that one is in the notes. Right. It says the credit purchases is 340 in 2025, 485. 340 and 485. 340 and 485. 340 and 485. 340. This one they said 485. Let me write it down there. 485. What about 2026? What was the trade payables? Let me change that one at least.
50,000.
It was
80,000.
it's 80,000. Okay. So give me the days.
Oh, it's 59.04.
So 59.04, right? So approximately
59 days.
49 days. Who's that 49? Is that 59.04?
59.04.
So approximately 59. So approximately 59 days, right? Right. And what about this one?
60.04.
60.04. So always write the answer there, 60.04, which is approximately
60 days.
60 days, right? So it takes you approximately 60 days to pay your creditors the amounts due to them. The last one, you can do it yourself. Inventory over cost of sales, right? This one you can do it. I just need confirmation. Inventory over cost of sales. The cost of sales figure is here. I don't need to type it. Cost of sales. You don't need to bring the negatives now. Just we are doing analysis. So pick the figure as you see it. Pick it as 50. If they brought it negative here, pick it 320. Don't add negative to it. Do you get me? So it's here. They said it's your inventory. So you come to your inventory. Inventory is here. 80,000 divided by what? Cost of sales 320 times 365. Are we good?
Yeah.
Are you good with working capital efficiency ratios? Are we good?
Yes, please. Yes.
Okay. So let me copy the next ratio we are going to be doing. That's the liquidity ratio. That one we just have two there. Oh, we have the turnovers. The turnovers, I believe you can do it. The turnovers. These ones. Since you just reverse them. Where is it? I'm not going to do it. The turnovers, these ones, you know how to do them. These turnover ratios. We've already done something similar, so you can do it. Okay. Now let's move on to the liquidity ratio. Now under the liquidity ratio, we just do these two: current asset, the current ratio, and the quick asset test ratio, right? Current ratio and quick asset test ratio, right? Okay. And then I need to copy. Let me copy just 2025. Let's do this one. Okay. So we are doing the liquidity. How easy you're able to convert your assets into cash, right? And the first one we'll be doing is the current ratio. How is it coded? Under the current ratio, under the current ratio, which is the CR, saying the CR is equal to what? The current assets, right? By just doing current asset over what? Current liabilities. So total current asset over total current liabilities. Right? Yes, this one. We just need it like this. We don't need to multiply by anything. Right. So let's do for 2025, then 2026. Right. State the formula, then you solve 2025. So what's the current assets for 2025? The total current assets?
160,000.
160,000. 160,000 divided by current liabilities.
100,000.
100,000. Right. What will be my answer? Same thing for 2026, right? Come a minute. So for 2026, what are the current assets? 2026, what are the current assets?
210,000.
210. 210. That is.
Yes.
And the current liability is what?
135,750.
135.
750.
Oops, 135. 135,750. 750. So this is how we do the current ratio. Right. The second one is going to be the quick. That's everything you do. The quick asset test ratio. Quick asset test ratio. That's how we say it. I hope I'm right. Quick ratio. We call it quick ratio or asset test, or quick ratio or asset test. Quick or asset test ratio. That's the name. That's how we call it. Quick or asset test ratio. That one too follows this one. Give me this one. Give me the answer. You got 1.6, right?
Yes, 1:1.3.
1:1. 1 point. It's supposed to be 1.6 is to 1. Oh.
Okay.
Why? Is to 1. Everything is to 1. And this one will be what?
1.55. So
1.55. No, don't do it 1.6. 2 decimal places. Right. 1.55 is to
1.
Yes, because 1.55 to some companies, they are dealing with millions and billions. So if you 1.6 is not the same as 1.55. Did you leave it like this? It was 1.55 what? Just 1.55.
1.546967.
Okay, 1.546. Okay, 1.55 is okay. So this is how we leave it. Now let's come to the quick ratio, right? Quick ratio, which is QR, quick ratio or asset test ratio, right? That one is basically your current assets minus your inventory. So we're just going to subtract inventory from it. I'm going to subtract inventory from it. Right. Going to subtract inventory from it. Right. We're going to do 2025. So we are going to still use the figures we did here. And we are going to subtract inventories. So start looking at the inventory figure. 2025, quick ratio. So for 2025, what was the inventory figure?
80,000.
80,000. 80,000. And for 2026, what was the figure?
110,000.
Okay, it's almost time. It's time and book. Okay. The last one, I'll touch on just 1 or 2 of them. I use my mouth to say it. Okay. So this one, to the answer you get, you just leave it in. Something is to 1. Right. The answer you get is to 1. Okay. I think the last one will be the GME ratio. And do the okay. You're not giving me the answers. Let me copy the last one.
0.8.
I'm coming. I have to then copy something and come. Say you got 0.8. 0.8, right? 0.8 is to 1. And the second one is what?
0.6. 0.74.
0.74 is to 1. Good. So these are your quick ratios, like your liquidity ratios. Just these two, right? Just these two: current ratio all over asset test ratio. Now the last one we'll be doing is these ones, the debt to equity ratio. Now your debt to equity ratio. Okay, I won't type this one. We are just going to use our eyes to look at it, right? So your debt to equity ratios is your long-term debt all over your shareholders' equity. So what is your long-term debt? More or less your non-current asset and liability, sorry. So what's your non-current liability?
For 2025 is 80,000.
80,000. So you are going to use these figures, right? For each year, non-current liabilities divided by what? You are saying debt to equity, right? The debt to equity, non-current liabilities all over equity. What's your equity? Total equity.
340.
340. So it will be 80,000 all over 340. Then this one will be 120 over 364. Right. Right. So that's your debt to equity ratio. Now, when we move on to the gearing ratio says that your long-term loan or non-current liability all over total equity plus your long-term liability. You understand? There's the formula. Your gearing ratio is what? Long-term debt all over shareholders' equity plus long-term debt. Are you with me? Are you here?
Yeah.
So that's how we are doing it. So I'll go there again, but let's look at interest cover. Interest cover says that profit before interest and tax over interest charges. Now, these interest charges, we can't really see the figure, so we just take finance costs, because finance cost is where the interest is. Finance cost is where the interest is. So profit before interest and tax over interest charges. Okay. So profit before interest and tax, we've already done it. Profit before interest and tax, which is 100,000, all over finance costs. So interest cover is how much of the profit can you use to pay your interest, right? So how many times? So it's basically your profit before interest and tax all over finance costs. So 100 over 10,000. Okay. So thank you very much for today. The next time we meet, if not me, talk, right? You need to do the time value of money, and you would also do valuing financial securities. I want to calculation. So let's end here. Thank you for your time. See you next week. Next week you have quiz.
Hello, sir.
Yeah, I'm listening, Juliana.
Please, the calculation that we did, please send it to us so that we'll be able to compare it when we are trying our hands on it.
Okay, I'm doing it right now, because I'll forget again.
Yeah.
Sure. Is that the only thing, the only consent? Next week we'll be meeting, right?
Yes.
Okay.
Please, I have a question.
Yes, please.
Please, with the statement of profit and loss, why
Yeah,
is that we have profit before tax in it, but still we calculated for another profit before tax? So I was
where was the
confused.
profit? This profit before tax. This one. What did I say this one is? Profit before I is what?
Interest.
This I here is what? Interest, yes. So a lot of analysis, we want to know the profit we got before we even paid interest. You see, we went to borrow money. When you borrow money, you pay interest. Sometimes we want to know the profit we had. That's why I call it operating profits. And that a lot of the times, that's what we use to do our analysis. The profit we got before our interest and tax, before even paying interest and tax, right? A lot of the time, that's what we use. Right? And most of the questions, they will compute it for us. I look like mine, you have to compute it yourself.
Okay.
Okay, all right. Okay, let me send it to you before I forget. Let me name it another, let me give it another name. Okay. If no questions for me, tutorials. If no questions for me, we can end today. You can end it. Okay,
Okay, thank you.
no problem. Send them. Okay, send them so you can access it. Bye bye.